Good morning, everybody, and welcome back to the Doomers News Network, where we don't do the financial cheerleading. We just call it like we see it. And while so many in the financial press will tell you anybody who's talking about the bad things in the economy are just trying to spread doom and FUD, over here, what we like to do is we like to call it exactly how we see it because we're beholden to nobody. We just call it as we see it. And with that, I'm going to turn it over to my buddy, Travis. Travis, take it away, brother.
All right, you guys, I'm looking forward to driving this whole thing today. I wanted to let the viewers know what to expect during this live broadcast. We'll do the best we can. We're going to have 6 stories today, you guys. The first story is going to be from Jack. And remember, you guys, I'm with the Slow Reading Group. I didn't go to school for all of this. I'm going to mispronounce some stuff, all right? Please don't crucify me, all right? First story is Trafigura. Trafigura. And the customer's not paying. I think that's how you pronounce it, Jack. The dollar shortage. Can you just pronounce that name for the viewers real quick?
That is Trafigura, as in try to figure it out before we go live, Travis. Yes, Trafigura.
Well, I did, and you guys made fun of me in the background, and that really messed me up. Now, the second story, you guys, is going to be from me. I'm going to bring in a guest, and we're going to talk about institutional investors fire selling some of their real estate and properties. That's a big story, actually. The third story is going to be from Melody, and it's going to be China fever dreams. We're going to talk about the real estate and what it has to do with China. I'm really excited about that one, Melody. The fourth one, Jack's going to go into the unemployment numbers, or rather the lack of unemployment. He's going to break up all of the stuff, guys. He's going to show you full-time versus part-time, a lot to uncover with the unemployment numbers. Fifth video is going to be from me. We're going to talk about generational home unaffordability. So we're going to look at Gen Zs versus Gen X, and I'm going to show you guys what to expect the second half of this decade. Very important. I'm really looking forward to that. Sixth one is going to be from Melody. She's going to go into a story from rent fixing. Obviously, there was a recent FBI raid for rent fixing, if I'm not mistaken. So very excited about that one as well, you guys. And we'll get started with Jack, but I wanted to tell the viewers, I know, there's some viewers from my channel. I wanted to quickly tell you guys why I even agreed to start this channel with Jack and Melody. First of all, you guys, I trust them. Jack and Melody, to me, are one of the best investigative journalists I've ever met in my life. But not only that, and I wanted to tell you guys this as viewers, behind the scenes, as far as what are we going to do with Doomers News Network, both of them, actually, you guys are over here, you're reversed. Both of them are thriving behind the scenes. What these two want to do for you guys as a community and with this channel is mind-blowing. So lots of love. I'm happy to be here. Don't know why you guys want to work with me. I can't even spell and pronounce things. Not even that smart. Have no college education, but I have a beard that's, it's halfway decent. Either way, you guys, let's start with Jack. Jack, please, sir, take it away.
All right. Thank you, Travis, for the intro. And what I want to talk to you guys today is about Trafigura. And again, Travis, excellent pronunciation. With that, we're going to share my screen there. So there's Trafigura. Now, real quick, if you're not familiar with this company, these guys are huge. They're not publicly traded. It's privately owned. It's owned by its employees. They're one of the biggest commodities trading funds in the world. These guys move literally boatloads of metals and energy all over the place, everywhere. All right. So big trouble at Trafigura could mean big trouble in other places. And this story that I'm going to talk about, I first caught wind of this one on Wednesday this week during one of my morning live streams over at my channel, Nobody Special Finance, shameless self-promotion. And that story slowly got more and more developed over the course of the day. And this ends up being a pretty big deal. And we still don't know what's causing it. That's another important thing, is there's a lot of speculation about what's going on over at Trafigura, but nobody is saying exactly what the problem is. So this all starts Wednesday with this article in Bloomberg. Now, Trafigura reported earnings, and the headline, Trafigura profit drops 73% as trading boom cycle fades. Now, this was actually an earnings beat for Trafigura. Their earnings were better than expected, and that 73% drop in earnings really wasn't that big of a deal because everybody was expecting it. There was this big commodities boom in 2022 with the Russian invasion of Ukraine, and energy prices and food prices, everything just boomed. And the way commodity prices work, people buy their commodities several months out ahead. And so really last year, we saw the main impact for Trafigura from the Russian invasion in 2022. And so that is now worn off. And so year over year, Trafigura has seen a big drop in their earnings as commodity prices have come down from those obscene highs that we saw immediately following the invasion. But that wasn't the story. I mean, I was reading through this story. Okay, this seems like a no, never mind. But as I've often learned, sometimes the best tidbits of information are hiding in the last paragraphs at Bloomberg. Bloomberg does this. They put the best nugget in those last one or two paragraphs, and this article did not disappoint. The company noted on Thursday that some clients were having payment problems due to high commodity prices. Invoices more than 60 days overdue were 16% at the end of March, up from 5% last September. So 60-day overdue invoices more than tripled just since September, and they're saying at the end of March. So in 6 months, customers having trouble paying Trafigura have tripled here. Now, this is when it got even worse. Expected credit losses on receivables also rose to $330.2 million from $3.3 million at the end of September. So rather than the threefold increase in the delinquencies in the 60 days overdue, now Trafigura is saying they expect people to not pay them. Not only are a lot of people overdue, but we expect $330 million worth of non-payment here. And that's up over 100-fold from just September. So in the last 6 months, or now really the last 9 months, because we're here in June, something is going on with Trafigura's customers. A lot of them are not paying. The losses applied to several counterparties in a number of different countries, Trafigura said. And that sentence is very important as well, because that rules out that, hey, maybe it was like this one firm that blew up and they took all this credit with them. You know, I'm thinking like an Archegos or some big miner goes under, but they're not saying that here. They're saying the losses applied to several counterparties in a number of different countries. So it's all over the world and several companies. We're starting to talk about counterparty risk in the commodity space here. And they're saying if you look at commodity prices where they are today, they're not the lowest. So that means that importing countries from time to time will have issues in their payment profile. That was according to Steven Jansma, who is succeeding the CFO. He's their new CFO over at Trafigura, he said in a recording. So there's big trouble going on with Trafigura's customers here. And then we got a little bit more a few hours later on that day. You know, again, this was at the very end of an article about an earnings beat for Trafigura. Well, later that day, they added a little more information about this. When we got this article on Bloomberg, Trafigura has a $1.7 billion headache after a surge in overdue debts. And now the numbers are getting bigger here. Now they're saying $1.7 billion. We were talking $330 million just a few hours ago. A solid headline profit for commodity trading giant Trafigura Group masked something unusual beneath the surface. A significant chunk of its customers have stopped paying. Trafigura was owed $10.5 billion by trade debtors at the end of March. Its half-yearly report showed on Thursday. Now, that's not unusual for the commodity trading giant, which sells hundreds of billions of dollars worth of oil, gas, and metals every year. But this time, a much larger proportion of them were late paying, Trafigura said. And this is when they go on to the 16% of receivables being 60 days late. Now, if you blow up that chart, this one is showing the overdue receivables, those 60-day past due invoices. Now, this chart, not so alarming, right? I mean, we were higher in 2016 with overdue invoices, and Trafigura didn't blow up back then. So, you know, when I saw this first chart, I'm thinking, all right, maybe things aren't that bad over at Trafigura. But then as you go back to the article and you start reading more, now they're starting to talk about those expected credit losses, how they went from 3.3 million in September to 330 million in March, a 100-fold increase. And they go on to provide a little bit of historical context for just how significant that is. In more than a decade of Trafigura's accounts that are public information, the company's expected credit loss on its receivables has never been higher than $6 million. It's $330.2 million now. It's never been higher than $6 million before. So when you look at that chart now, they put that in context. Let's blow that one up a little bit here. Now here's Trafigura's expected credit losses. And this chart is kind of what made me say, whoa, something is majorly wrong in the commodity space here. All right, so remember from the previous chart, okay, 2016 wasn't so bad. They had a lot of overdue receivables back then. But if you look at 2016 on the credit losses, everybody paid back in 2016. So they were late, but they paid. What Trafigura is saying here is everybody's late and they're not going to pay. They're already taking the hit and the expected credit losses, which means they're writing down that accounts receivable. So something is majorly wrong in the commodity space right now. Now, most commodity trade across the whole world happens in US dollars. It doesn't really affect us so much. We pay for oil in our native currency here in the States. But if you're a country overseas in emerging markets, before you can buy food, before you can buy copper, before you can buy gold or oil or natural gas, first you need to buy dollars. Then you can buy your copper because all of this global trade happens in dollars. So keep in mind what we're seeing here with everybody failing to pay. This is a dollar shortage starting in several places across the world. And remember, Trafigura told us this isn't one company from one country. This is several companies spread across multiple different countries in the world. So there is an emerging dollar shortage happening in the commodities market. So far, it's only impacting Trafigura. We haven't heard anything from any of the other ones, but this could be a very big deal. Now, I went and I tried to find a couple of examples of, maybe what might be causing this. And I did find a couple of stories that might be giving us a hint at what's going on. There's a lot of losses. Trafigura, this story was back in February. Trafigura faces Mongolia oil losses in new blow for the trading giant. So it's possible the oil trade in Mongolia is playing a role here. Mongolia has been pretty famous because, number one, it's the second biggest landlocked country in the world. Mongolia doesn't have any coastline, and yet somehow they're operating a huge fleet of oil tankers now, because when the Russian oil sanctions were passed, a lot of companies were no longer able to transact for Russian oil. So Mongolia created, they're calling it a shadow fleet, where there's vessels owned by foreign companies are now sailing under the flag of Mongolia, and they're meeting out in the middle of the ocean with Russian oil tankers, transferring the cargo, and then that oil is being sold into Western markets in violation of U.S. sanctions. So Mongolia is expecting to take a lot of losses from oil trades. Now, nobody is saying what's going on here, but it's entirely plausible that the Western governments are starting to crack down on this shadow fleet that is helping to sell Russian oil into U.S. markets. And if that's the case, then those Mongolian companies won't be getting paid for that, and then they won't be able to pay Trafigura for that. So it's possible that's what's going on here. Also, Mongolia bought almost all of their oil from Russia before the sanctions went into place. And there's a lot of articles about how the Mongolian economy is struggling now because planes won't fly over Mongolia anymore, because you have to fly over Russia if you're flying over Mongolia. And so the Mongolian economy used to collect a lot of fees from airlines for flying over their airspace. That revenue has been cut off. The energy trade has been complicated. So the Mongolian economy has really been hurt by the Russian sanctions. It's possible that's at play here. We've also had a big nickel fraud in the last year or so. Alleged $600 million nickel fraudster can't pay his bills. Trafigura was caught up in this one. There was this guy named Gupta who was trading in the nickel markets, delivering nickel futures. And it turns out instead of metal, they were bags of spray painted rocks. And this was a several $100 million fraud. There's been lawsuits in every different direction, and Trafigura was one of the companies involved there. So it's possible this big nickel fraud is also contributing to Trafigura's problems. And then there's the scarier scenario here. And that scarier scenario is countries like Turkey, countries like Sri Lanka, like Lebanon, countries that are reliant on imports. And a lot of these countries have had runaway inflation in their native currencies over the last few years. And they've been dumping their dollar reserves like gangbusters to try to prop up their native currencies in the Forex markets. And if those countries are now running out of dollar reserves, then they won't have the dollars they need to buy their commodities. So this is one of the reasons why I kind of latched on to this topic, was this could be the early indications of a dollar shortage in the global commodities market. And if that's the case, a dollar shortage, that's going to start to mean things like a much higher DXY, the US dollar index, like much higher interest rates for US dollar denominated debt. And that could have real impacts on everything from your credit card to mortgage rates to stock valuations, gold and silver prices, oil prices. the dollar is the lubricant of the global economy. And if we run low on lubricant, it's really going to slow down trade. And that's what I got for you guys on Trafigura.
Yeah, so very interesting, Jack. Couple of things like I'll be talking about Mongolia as well when we talk about China and a very interesting ghost city that Al Jazeera did a story on in 2011. But dollar shortage, I think this is really important because that sounds kind of, oh, you're just short a couple of dollars, right? But in reality, when you look back at the GFC, it wasn't subprime mortgages that caused these credit meltdowns and events. It was a dollar shortage. When people turned around and said, hey, Bear, Lehman, you guys owe a certain amount, and they didn't have the collateral anymore, or dollars equals collateral. So this could be a really big story, Jack, that's kind of hiding, like you say, in these paragraphs. So, in your opinion, do you think this could play out faster? We heard about that nickel story with Chase. What was that, a year ago, 2 years ago, where they opened the vaults and it's like, oh, we thought we had all this nickel, but in reality, there's nothing there. And that's very much right. The bezel that we talk about, like the fraud embedded in this economy. But, this may have been playing out for a long time, but do you think that things might accelerate here quickly?
So far, this story is limited to Trafigura, and Trafigura has had that Mongolian story and that nickel story. So far, no, I'm not totally freaked out by this. Now, if we, in the next few days or weeks, if we start to hear about Cargill having the same problem, then yeah, now it's a pattern. Now it's potentially a systemic thing. So right now it's limited to Trafigura. So I don't want to overdo it with the doom here. Let's rein in the doom a little bit. Right now it's just an isolated case, but it's a big isolated case, a 100-fold increase in expected credit losses on those receivables. Doubling, tripling is a big deal. A 100-fold increase. You're talking exponential rises in non-payment and counterparty risk. That's potentially huge. And, guys, there's this massive market of Forex swaps that's out there. And, it's basically, company A has dollars, company B has euros, and they just swap based on the current exchange rate. And the funny thing about those is they're balance sheet neutral. They don't happen on balance sheet. And nobody really knows how big the FX swaps market is. We know it's in the hundreds of trillions, potentially the quadrillions. And the International Monetary Fund has done reports about this, warning that the FX swaps market, if there was ever even the slightest bit of problem in there, it could wipe out some of the biggest firms in the world. And so if we're talking dollar shortages at Trafigura, this is something, if it ever spills over and causes problems in the FX swaps market, that's going to be a really big problem. And the numbers there are so big in the FX swaps market that nobody really knows how to try to analyze or model what that might look like for valuations elsewhere in the economy.
And we know there's been a race on for these metals, right? I mean, in terms of there's so many different, we're at a disadvantage. China has been stockpiling this stuff for some time. And so the commodities market has played a very important role recently. And I think there are a lot of people participating in this market. So to me, this is a story we definitely need to keep our eyes on.
Absolutely.
Jack, I got some clarity needed. So I wanted some clarity. Then I have a question for you. But just to reiterate what you were saying, because as I'm sitting here, I'm asking myself, how does what you're saying impact me as a normal, at best, middle-class citizen? How is this impacting me? And essentially, I believe what you're saying is, as a result of this dollar shortage that could potentially hurt us as America, even though it's across the world, right? Geopolitical, even though it's across the world, it can hurt us here in America because it puts pressure on rates going up. Is that correct, Jack?
Yes. And let me put the caveat that the dollar shortage, that's me speculating a little bit. All right. I'm seeing this story at Trafigura and I'm speculating that we have a dollar shortage developing. So we haven't confirmed that. But if there is a dollar shortage, and there's early indications that there are, think of dollars in terms of supply and demand like any other product, right? If there's a shortage of it, if the demand exceeds the supply, the price of the dollar starts to go up. And what is the price of money? The price of money is interest rates. And so a dollar shortage means more and more people go try to borrow dollars and start bidding up the interest rates, bidding up the price of those dollars. And when interest rates start to rise, in the Forex market or in the dollar market, US treasuries, everything, that ripples across the whole economy. That's going to eventually affect how much it costs you to borrow on your credit card, how much to borrow for a car, how much to borrow for a house. And of course, a lot of companies right now are struggling with the already higher interest rates. So we've got things like commercial real estate are having trouble. We've got small businesses that are trying to refinance debt in the higher interest rates. So if we get a dollar shortage in the commodity market and we lose control of it, it could result in higher interest rates here at home in every corner of the economy.
And in other words, and also what I'm trying to kind of hammer down here is that, being how the world is right now, so geopolitical, the globalization, I'm just letting people know outside parties can manipulate what's going on in the US, even on Main Street. So we have all these outside parties, and not just the government, but corporations. So a lot going on. But my question, Jack, real question was, I noticed in that chart that you had pulled up that there was a massive acceleration in overdue invoices that led to losses, unlike 2016. Can you tell us what happened in the last, 6 months? Because we're not even done with 2024. What happened in the last 6 months that caused those overdue invoices to literally skyrocket? What exactly happened, Jack? Was it just oil?
And that's the rub of this story there, Travis, is we don't know. The whole second half of my presentation there was me speculating maybe it's this Mongolian oil thing, which could be related to the Russian sanctions story, or maybe it's this nickel thing, or maybe it's this story of the central banks dumping their dollar reserves to try to prop up their currencies, right? We saw trouble in Sri Lanka a few years ago. They didn't have enough dollars and the Sri Lankan rupee was collapsing and it led to food shortages. So all these countries around the world, in emerging markets, and there was some articles where they specifically called out emerging markets at Trafigura, they have been using what dollars they have, selling those dollars to buy their own currency to stop the decline of value of their own currency. And you can do that as long as you have dollars to sell. And if you run out of dollars to sell to prop up your own currency, you also run out of dollars to pay for your oil and to pay for your food and your metal imports. So if that's going on, if it's the central banks running out of Forex reserves, that's an even bigger story then, because now we could potentially be talking about runaway inflation in emerging markets. And, places like Turkey, you've already got 60-70% inflation. So this could really blow up, and again, it's still early innings. It's just limited to Trafigura. But if we see this spread to other commodity traders, then that is a big, big problem.
Jack, I got 4 comments, so we'll try to make our way through this as quickly as possible. There's some good stuff. Here's the first comment right here. Just want to know your thoughts on this. What are your thoughts on this? Russian sanctions are only hurting us, the West. Silly goober.
I would say they're not only hurting us, but I would say they are also hurting us. They're hurting the Russians too. All right. Now, who is hurting more? You're talking propaganda on both sides in the press, and it's really hard to separate that out. But it is a war of attrition economically, and historically speaking, getting involved in a war of attrition with the Russians has not been a winning proposition. Only the Afghans pulled that one off, and they kicked our butts too. So yeah, that was my quick answer.
So polarizing, Jack. You're just so polarizing. So I have another one right here. This one's good, man. Is the premeditated dollar shortage going to bring prices up or down for metals and commodities, in your opinion?
So a dollar shortage means a stronger dollar, which puts downward pressure on assets priced in dollars. So if we do get a dollar shortage, that would put downward pressure on oil, gold, and silver because, hey, we can't afford to buy the dollars. So we're going to start buying less gold, buying less oil, which would mean the price of those things start to fall until the buying starts. But the central bank response to a dollar shortage is almost always to lower interest rates and print money, in which case that would abruptly reverse course and send those prices higher. So the big question there isn't so much what would the dollar shortage do, it's what would the central banks do in response to that dollar shortage.
Great. Okay, couple more here. I got one ending question for Melody. First question for Mr. Watson. Really good guy. I love Mr. Watson. We really hold each other accountable in our Discord, which is to say we beat each other up. Mr. Watson and I, we beat each other up. I love it. We love that type of relationship. I don't want to speak for you, Mr. Watson. Question for Jack. What happened with metals yesterday, which would be Friday, June 7th?
So yesterday morning, we got the non-farm payrolls report. And we'll talk about that a little bit more later on in the stream. But we had more jobs added than expected. 272,000 jobs added was the headline versus 185,000 expected. A stronger labor market right now means probably a less aggressive central bank later this year, which means the cut in interest rates is probably not going to happen as soon as the market was expecting. And that sent the US dollar higher and interest rates higher. And speaking of the effect that we saw of the dollar shortage, what we were trying to anticipate just a minute ago, stronger dollar, higher interest rates usually puts downward pressure on gold and silver prices. And that's what we got yesterday.
We have a little bit of extra time. My guest is here, but we have about 4 minutes. I want to throw this question up. I had a question for Melody, but it was more of a lighthearted thing, making fun of you and I, Jack. But here's a really good one. This is from Nathan. Obviously, we're doing the best I can, but they're saying, seriously, guys, seriously, when is the recession going to happen? When does MSN talking heads in the suits, talking heads, start talking about it? Melody?
When they get permission from the administration. So, and I have been conjecturing here recently that I think they're probably the Democrats are probably going to have to pivot on the economy. There are just too many troubling signs of what's happening. They're going to, obviously they don't want to do that. They would rather try and extend and pretend all the way to the election. But I just think we're getting, too many conflicting narratives out there saying that things aren't as rosy as they think. And so when is a recession coming? When, the NBER proclaims it, but I believe it's already here. And honestly, I ascribe to what Danielle DiMartino Booth. I think it started in October or around there.
Jack?
Deficit spending in the United States, new government debt is 7% of GDP right now. 7%. So right now the government is spending money like we're already elbow deep in a recession. And we're not, at least textbook, right? And for the average person on the street, most people would say we're in a recession based on their experience in life. But the government is spending so much money to create the illusion of economic activity. It's not, it's just debt spending, wasteful debt spending, that it looks like we still have GDP growth, and they won't call it a recession until we get 2 consecutive quarters of negative GDP growth. We haven't even had one yet. And a rise in unemployment, which is just starting now. And we'll talk about that more in a little bit. So probably not until after the election will anybody admit we're in a recession.
And we have a little bit of time. So I really appreciate these questions. Melody, we're in the land of imagination right now. It's really fun to live here. Too bad we still have to pay taxes when we wake up out of the land of imagination. But from a scale of 1 to 10, how severe, Melody, will this recession be?
Yeah. So, in many ways, I think I personally believe we've been living in a silent depression since the beginning of the GFC, actually 2007. And so honestly, I think it's pretty severe already. I think if you really look at how much earning power, purchasing power has disappeared. What I would argue is that mainstream media has been very quiet on our living conditions, the labor participation rate, which I'm sure Jack is going to talk about. And so I think things are already pretty bad. If you talk to, the bottom 80%, which is the majority of Americans, how bad is it going to get? I think that depends on what crazy antics our government decides to pull. I mean, you can look back at the Great Depression, so many different things they tried to generate, economic activity that just didn't work, like the tariffs. And you can see that we're doing something very similarly right now. So it's hard to say, but I don't want to kind of downplay how bad it is already. But I do think unless there is an exogenous event or something that happens to get us out of this, like a war, unfortunately, this could persist for some time, for the next, 5 years.
And Jack, we have 30 seconds left. Can you go ahead and answer that?
It depends on what the central bank and the Treasury does. They're already spending 7% of GDP on new debt. They're already spending like in a recession. So if they do nothing, the recession will be massive, but they're not going to do nothing. They're going to lower interest rates and print money. So I don't know how much of that they're going to do, but how much of that they do will determine, number one, how deep the recession goes, and also how bad the inflation coming out of it is going to be.
Okay, thank you, sir. So that is a wrap. We're going to move on to our next story. I actually have a very special guest with us. It's real estate, our RE watchman, Sean. Sean, how are you, brother?
Good morning. Really
Good
grateful to
morning.
be here. Big fans of all three of you. So thanks for having me.
Thanks for being here, brother. And you guys may have watched Sean on my channel recently, but Sean's going to talk to us today about institutional investors essentially fire selling their single family residential homes. Now, this is a very big story because remember what we hear in mainstream media, that the housing market's resilient, that institutional investors are going to keep these houses forever. So the fact that these institutional investors, who again, their business is designed to hold houses, the fact that they're now fire selling properties, to me, it's a clear indication of two things. Number one, liquidity squeeze. Maybe the lag effect's finally catching up and they need money now. Number two, their assets are no longer performing, whether it be property taxes skyrocketing in Texas or competition, vacancy. There's many things, but I'm going to give it to you, Sean. And let me share your screen right here. And you guys don't forget, real quick, go to RE Watchman on YouTube. Subscribe to this man's YouTube. He's got some great data. He's a great person. Sean, mic is yours, brother.
Thank you so much. And you mentioned we did talk about this earlier in the week. So I will add a lot of things that have kind of developed since then, but just to fill anyone in who missed that video earlier in the week, and also just give you a little background of where I'm coming from briefly. So I like to think of this as, where were you during the great financial crisis in the last housing bubble, right? So for me, 2008, I was in college studying social psychology and economics, which I think both come into an interesting interplay when you think about bubbles and behavior. We like to think people are rational in their decision making, but it's amazing how much emotion comes in, even to financial decisions, et cetera, et cetera. So, and then I bought my first property in 2012. And so whereas some of my neighbors paid prices in 2005 that wouldn't really recover for 10 years, I bought mine in 2012 at the bottom and it doubled in 4 years. So that was my experience in the last sort of housing downturn, to really be, able to kind of reap the benefits and the opportunity that came from that. And so as I relocated, I really started digging into the San Antonio housing market, had to leave behind my low rate in another city. And what I've found since then, just a lot of interesting things. The layers continue to be peeled back. And where I would start is, you mentioned some of the interesting kind of questions about, why does this matter, right? Why does this matter to me as a consumer, what these institutional investors are doing? The way I would frame it is, oftentimes when we talk about how housing has become so unaffordable, right? I know one of the studies says 80% of people can't afford, the 80% of homes, are unaffordable to the median buyer, right? And so people will often respond, well, it doesn't matter if homes are unaffordable because, investors will come swoop in and buy these homes, right? And you'll even see kind of a myth quoted. They'll say, well, BlackRock's going to buy them. Okay, well, BlackRock doesn't actually buy homes, right? They are a 6 or 7% stake in American Homes for Rent, a public company that does buy and rent out homes. But American Homes for Rent has now started selling them in Texas. So they sold 600 plus homes in 2023 after years of being a net buyer. So clearly there are shifts happening that are interesting to watch and try to understand, hey, what does this mean for me? What does this investor activity mean? And more than anything, I think try to push back on the notion that, hey, if homes are unaffordable for consumers, then these investors will just buy them, because what I think we're seeing is that they are no longer able to pass on those costs to a tapped out consumer in the form of higher rents. So if you look here, I think you can see the visual, right? We've got that pulled up. Yeah, I can see it. So the pattern that I'm seeing, you'll see these little icons. These are new construction neighborhoods built by Lennar, where First Key Homes in San Antonio bought 400 homes in the last 2 or 3 years. And so the little red icons are homes that First Key bought in these Lennar new construction neighborhoods. The blue icons are, I just call them individuals, people who own only one home, right? So it's owner occupant properties. So these are not build for rent communities. These are communities where people moved in expecting to, buy into a community that was mostly owners. And, institutional investors have bought a significant portion of the street. Well, you'll see in the yellow, these
Sean,
are now the homes for sale.
Sean,
Yes.
real quick, I just want to reiterate what you said to the viewers. I really want them to understand what they're looking at. This is very, very valuable, you guys, what you're looking at right here. This is such a huge story. He's showing you a brand new neighborhood. So what you're looking at, it's brand spanking new. It's the Lennar neighborhood. And you're looking at institutional investors mixing in with normal citizens. Everything in blue is a normal citizen. It's normal, more than likely, primary residence, owner occupied. But all of those red little dots are institutional investors that swoop in and buy clusters of these new homes. And the yellow dots is what you're seeing as far as those same institutional investors that wrecked the value and the neighborhood now saying, oh, we messed up and we got to sell. Is that correct so far, brother?
Exactly. You nailed it. So the yellow are essentially, I'm going to show you several of these neighborhoods to show you this is not just cherry picking one example, but what you'll see is that they purchased 400 homes across about 10 neighborhoods. And now in most of those neighborhoods, they are now selling homes. And so the question is why? It's so, soon since they purchased them. And there are a number of reasons contributing to this. But like you mentioned, I spoke to people in one of the neighborhoods, right? Homeowners. They weren't aware that an investor had come in and bought a quarter of their street. And when we talked about that, they said, well, I did notice there were some for rent signs that didn't go away for a long time. They were there for a very long time, right? And so as you we'll look into some of the history of some of these listings, but clearly the investor didn't have a grasp of what rents would go for. So rents were lowering. We're also seeing the investors now have much higher property taxes as inflation has been passed on in the form of those property taxes. And so the investors have higher costs. They're getting lower rents. And so now they're selling. And so the question is why, right? You mentioned liquidity. We'll get to all that, but I just want to show several of these examples here. So here's one example. Again, the red are the homes bought by the investor. The blue are just owner occupants. The yellow are the homes that are now being listed for sale only a few years after they purchased these large chunks. So here's one neighborhood, and this is all in San Antonio. Here's another neighborhood. You see a couple of yellow, in each of these blocks. You see a lot of red, a lot of investor purchases, but then also a lot of people who moved in there as families. Just a couple of more of these, just so that you see it's the same pattern. It's like a script. And so once you start digging into it, you'll notice just a few themes, right? Again, over and over again. One of the themes, obviously, is, Travis, you've talked a lot about, sort of the census and the revisions to their graphs on what new construction was selling for and, the all-time highs, quote unquote, that have been revised. Well, this listing in particular is interesting in one of these neighborhoods where you see on the right, and I'm going to get more into this a little bit, how to look at property Central Appraisal District websites and see who owns these homes. But FKH, First Key Homes, you see they own all of these homes. And then on the left, you see, this home was listed by Lennar for $354 in 2022. First Key tried to sell it. They listed it originally below that at $315, and now it's dropped all the way down to $285. Right.
Okay.
And you could argue, okay, well, maybe they got a discount from Lennar's sticker price when they first bought. And okay, maybe they did. And Texas is non-disclosure, right? So I don't have access to what the actual sale prices were. But even if they got a discount, my point is a consumer likely paid the full price in 2022, right? Yeah. And if anything, the people I talked to shared the same sort of story that you hear, which is the narrative is, the incentives were in the form of rates, right? I get a lower rate on this house. I don't get any sticker price lowering. And so what happens is whether the investor bought them at that time at a lower price or they're definitely selling them now at a lower price, the implication is, essentially at some point, this investor is continuing to drop the price, and that affects the equity of the person who bought their home, right?
And Sean,
Yes.
For the viewers, I want to explain, because you just touched on the part of the story. I mean, I think this is huge. And for the viewers, just one more time, what he's showing you is that Lennar, it doesn't tell us exactly what it sold for, but going back to that Lennar where you're just at, Lennar could have sold the house to this institutional investor for $354,000. Okay, we don't know; it's non-disclosure state. Fast forward about a year and a half later, that same property is now being sold for well less than $354,000, now being sold at $285,000. And what I wanted to bring up, Sean, and you were kind of getting at this, I think this is brilliant. 3 comps and you're out. Not 3 strikes. Okay, this is my thing. Okay, 3 comps and you're out. The fact that these institutional investors are selling for, it appears, we need more info, but it appears for under market value, that is absolutely dooming the locals, because the way that appraisal value works, 3 comps. You got 3 comps that are being sold for under market value. Guess what? It's no longer under market value. It's now market value. So you need 3, boom, you just drop the market value. So can you see these institutional investors, by them doing this, do you think that it puts the existing homeowners in danger of price decline?
Absolutely. And, I think the other interesting element is they're also now competing with the builder to sell these homes, which was partly why they're probably dropping them by so much. But, someone who I really respect and appreciate their perspective and their content chimed in and said, well, how can you compare these, 2022 list prices to what they're selling for now? I mean, what if it's a home with 100 cats in it and it's, in bad shape? And, I'm thinking, okay, I don't know what the going rate is for the depreciation per cat calculation, but that would be a pretty high amount. If that's the case, I really need to get into the cat remediation business, because that sounds very lucrative. But the point is, okay, if they own all of these other homes on the same street, why would they continue dropping the price? Why wouldn't they just fix it back to to being at the level of where it was just a few years ago? And someone mentioned in the chat, yes, I think that is one of the possible reasons. You'll notice they have open protests on tax appraisals on these homes, right? So it gives them this power, where as an individual, if I want to protest my property taxes, I don't have another one down the street that I can just sell to kind of manipulate the value and then hopefully lower the taxes on 20 something other homes on the same street, right? They have this power from owning the number that they own that leads to, just some possibility for some questionable things. And so, and you mentioned it could be liquidity. We're going to get into that as well. I mean, I think there's, if you look at some of the headlines when it comes to REITs and things like that's a possibility as well. But either way, I think, I'm coming at it from the perspective of, I'm just a consumer, a citizen. I'm just asking the questions. I don't necessarily have all the answers, but one of the things that I am trying to do is equip people to go into potentially purchasing a home and be able to ask those same questions in your area, right? Because I think one of the things people will say is, oh, large investors only own a small percentage of homes in the US. And yes, that's true. But it's clearly not a small percentage of homes on that block, right? I don't care what the national statistic is. I care about the block that I'm actually trying to considering purchasing in. And so if we look kind of at just some other data points, I mean, if you look at the history, like I mentioned, it's just price drop after price drop on the rent. So what I think they did is they really just sort of mispriced what they thought they could get in terms of rent. And a lot of that has to do with the areas that they're choosing to buy in, which is a whole nother story that I'm going to be producing some content on. But essentially, when I was driving around one of these areas, I was looking for a coffee shop to plug my laptop in, and all they had was a truck stop McDonald's, right? So they picked these areas that they thought, well, we can get cheap land and maybe they're up and coming. And what I really think happened is that out of towners moving in thought, oh, I heard this place was up and coming. Let me buy this home. But the locals really aren't interested in a lot of these areas. And that's what you've seen, in the video we had this past week, Travis. Someone said, these are terrible areas. And that's the thing, is that I think national builders and then national investors had this idea of what was happening. And we'll get into this later. And some of that was very specific to, 2021, the pandemic, et cetera. And so they've had the speculation, and it turns out that the numbers aren't working out in their favor. And so you could also point to the builders' financials are doing great. Okay, well, how many of these homes are they selling to investors under the premise the investors are going to make money renting them? So the builders' financials look okay, but really it's sort of they're just passing it on, and we haven't, the builder hasn't really sort of in their financials faced that, well, maybe these homes aren't worth what they thought they were. So you see the rents dropping. I mentioned the taxes going up. And then here's another, like I mentioned, here's another interesting kind of tidbit is this is a street. I'm looking at the property appraiser website, which you can do. And, I want to do more of an in-depth how-to on how to do that. But you'll see at the top here, these are the homes owned by FKH, First Key Homes. I redacted the individuals' names just because I don't want to put anybody on blast here on a public video. But you'll see at the bottom, these are the Lennar homes on the same street, right? So it's really interesting to think that not only do you can't get the rents you expect as an investor, your property taxes are going up, and you're also trying to sell homes where the builder is continuing to build new homes and lots of them. And so you just have this situation where all of these factors, and there's even more factors than that. I mean, you look at the amount of building, this is a picture I took of all the different builder signs with a few little political signs mixed in there. But, you see all of these builders building in some of these areas that are, again, not really prime areas. They're further out. There's not a lot there. And, if you look at the appraiser websites, you see that the builders own way more homes than are listed. Many of them are just lots, or maybe they're not very far along in the building process. But the point is, if they're already not getting, these investors already aren't getting the rent they expect, what happens when you have many, many, many more sort of hitting the market? And so this is an example of where you see,
Sean, sorry, if I could just step in real quick. I just want to add, like, what's really important and kind of tying in the story that Travis did last week about the revision to the census numbers for, new homes and things like that, is that all of these builders use these assets for pledging to their facilities. So as Jack was talking about the dollar shortage, the collateral shortage, this is also going to create dollar shortages for these national builders who, let's say last month they had, thousands of properties listed at 350,000 and pledged to their warehouse facility. And then this month, those are worth 250,000. Well, what they're going to have to do is suddenly you're going to have a liquidity shortage event because you have less available cash than you thought. And you're continue. So this is what happens, and this is how these liquidity shortages can just happen overnight. And people like Lennar, they have gone out into the market saying that they are not going to reserve cash. They're not building up a cash cushion. And so in this world of borrowing, they need these assets to be overvalued. And sorry, I just wanted to kind of interject that really quickly.
No, I'm so glad you did. And, I know I'm running out of my time slot here. I want to just kind of lightning round a few things before we close here. But, great point. And I'm so glad to have your perspective on this. I mean, just to illustrate here, Lennar, new home source, it says they have 736 homes. You go to the property assessor website, it says Lennar has, 2,500. So what are they going to do with them? And I've gone to some of these locations and have some video I need to edit, but it's amazing the amount of inventory. And what that leads to is, we talked about, this is an institutional investor here who, Tricon, who, I said yesterday, they're offering 2 months rent. Well, they've upped the ante. Now it's 6 weeks free rent plus 50% off security deposits. So they're finding, oh no, these numbers I thought I would get for rent, rather than lowering the sticker price. It's kind of like the builders. They're trying to offer incentives, hoping that they don't have to fully lower the price. But I think the discounts on even the sticker price are coming. And so, if you expand this story, I'm very micro focused on San Antonio. I saw someone ask about an area in Florida. I'm starting to look into more areas. And so an example here, this is First Key Homes in Cape Coral, who's getting a lot of press about their inventory and things like that. You see, this is the yellow being the first key homes for sale and the purple being the ones they've bought in the last few years since 2020. So they bought a lot and now they're selling a lot. And you could add any number of theories why that is, but they even their listings here offer a little bit of a different flavor than San Antonio. Whereas here, I mean, in this particular example, they paid almost double for a home built in 2020 and 2022. Now, Florida, it will tell you what they actually pay, whereas Texas, it's obfuscated. But huge property tax increases. They overpaid for these homes because now they clearly, if you look at they tried to get a certain amount of rent, they had to drop it. So now they're selling tons of these homes just as the inventories are skyrocketing in these areas. Georgia, we're also seeing some of these institutional investors sell. So Texas, Florida, I'm also kind of looking at what are some of the next states to be part of this phenomenon. And so I've seen some Georgia examples. I know I'm out of time. We didn't even get into the build for rent, the apartment occupancy here being really low. There's so much to cover, but I really appreciate, just the platform and being able to be here and speak to you all.
Sean,
okay, so we got to be
ahead.
fast. We got to be fast because I got like 7 questions from the users, but I wanted to remind the viewers just real quick one more time. Sorry I saw you guys making fun of me in the private chat. That's funny. I wish I could show them what you guys are they're calling me names in that private chat. You guys trying to mess me up. Anyways, you guys don't forget to go to real estate. Wait, that's not right. I apologize. Right here. You guys don't forget to go to Real Estate Watchman or RE Watchman. Subscribe to his channel. He's also on X and Twitter. So I just want to give you one more plug. But starting with Jack, can you guys quickly ask him some questions and then we'll go to the viewers?
Sean, fantastic. I am 100% aligned with the premise that the institutional investors are really in trouble here. And I've seen this for a couple of years now. I get comments on a lot of my channel that the government should do something, that we need to make it illegal for Blackstone to buy private single family homes. And my answer has always been the same. Don't touch it. Just, these guys are going to learn their lessons. They're going to bleed money. They're overpaying for houses. And if people can't afford the rents, just like you were saying, then these houses aren't going to cash flow and these institutional investors are going to get wiped out. And as it happens, just this week, I got a private message from a viewer. And, I'm not going to break confidences or anything, but a major home builder in the United States is looking to offload several dozen neighborhoods, not houses, neighborhoods. Each neighborhood is 100+ homes. And the reason why they're looking to offload these thousands of homes, tens of thousands of homes, I didn't do the math, but is because they have a big interest payment coming up this summer and they don't want to make that interest payment. So these institutional investors that we've been saying, oh, they're victimizing us by creating this bubble, they're struggling for life right now because the interest rates are killing them on the debt to buy these homes. So how might they sleaze their way out of this, I guess, is my question. Are they going to go hat in hand to the government for some kind of bailout or liquidity injection? Do they have an out here, or are they just screwed?
Yeah, and I totally agree with you. Just on this, from the standpoint, people have proposed laws to fix this. And I tend to be someone who says, to your point, the free market will work this out. I mean, I think I definitely don't support them being forced to sell their homes, because I think that would be, we're already seeing inventories rise significantly even without that. So, from the standpoint of, I just think, like you said, the can has been kicked down the road. And I think they're starting to find out that some of these investments they made didn't work out how they thought. And so, I think just my main message is, as consumers, just be aware of this and know what's going on. And rather than let's go try to create some laws to change what they can do, let's be more informed as consumers and know, am I moving into a neighborhood where they're going to, potentially the builder is going to have a lot of excess inventory and want to sell to an investor or want to sell at a deep discount relative to what I paid.
And Sean, we have about 6 minutes left here. I have a next question here, and this is kind of what we were talking about earlier. And I want you to just run with this, Sean. Okay, hit the home run here. This is an easy pitch. Knock this out. How many homes are they selling per subdivision or per neighborhood? Is it just 2 or 3? And is it to manipulate the tax assessment for the next year's property taxes? What do you think?
Yeah, so it is a few homes in each neighborhood, right? And that's one of the theories, is that they're doing it, like I mentioned, they have open appraisal protests on, all of these homes. So if they sell a few for less, that obviously would then give them a more compelling case to say, hey, lower my taxes on the other 25 on this street based on these two that I sold, right? So that's one possibility. I mean, you could also think about, and I'm not an accountant and definitely not a financial advisor, right? So just a little disclaimer, but if you think about it, I think other people have suggested, well, maybe this could be for write-offs, right? If you own all of these homes and now you're saying, okay, I had them on the books worth this amount, but I need the cash, or I need in some ways for this to hit my books so that I can write it off for whatever other reason, that could be one possibility as well. Or they could just need the cash, like you mentioned. I mean, there's been some really interesting articles, especially about, so First Key is owned by Cerberus, and their financials aren't, public like some other companies are. But, there's been some interesting articles, like Business Insider had an article about Blackstone REIT. And, they're sort of, they called it a house of cards, right? There's not a lot of transparency. How do you really value these assets? People are investing, and so really there's a lot of questions. And at the end of the day, I can't definitively say which one of these possibilities it is, but all I can say is it's pretty odd to sell some homes 2 years later at a discount when you just bought a bunch. It's clearly a reversal in strategy, and you're clearly either trying to manipulate something, or you're admitting that this was a bad investment. And we see the same thing by Fundrise. They're the one that, you can invest as little as $10 and have access to private equity like real estate investment. Well, they're selling 15 homes in a community in Austin now, right? Where they said they were going to buy all of these homes, and they had these plans, and these plans were based on, hey, these are great places for migration and social distancing. Well, now they're pivoting. They originally planned, to buy many more. Now they're selling them. So all it says is that these companies are under pressure to make changes to their strategy. And yeah.
Sean, what do you think? What do you think about this comment right here? There's been, and I understand both sides of the coin. Okay, so on one side of the coin, you have greed, corruption, and fraud from investors, and then on the other side of the coin, you have government regulation. Both are bad. Both are not good. And so this comment makes a lot of sense, and I respect it. And what they're saying is it's not a free market. It may seem like a free market, but it's not a free market. They're saying, I didn't say this. Don't be coming at me. Okay, I just want your opinion. Laws are needed. Again, there's some people said no laws. Jack just said it's going to correct itself. The more intervention, horrible. Just let this freaking thing bust and break, and let's reset and start healing together as a nation, right? But we got bad people in control of things. So what do you make of this comment, Sean, and what can be done to fix this?
Yeah, no, it's a valid point, and I certainly believe in consumer protections, right? And I think there's a middle ground as well. I know it's proposed, hey, maybe I think in the foreclosure space or auction space, there are sort of like periods of time, where certain entities are not able to bid for the first 30 days, as an example, right? Because there are individuals who benefit from being able to sell their home to an investor if no one else wants it, right? So I think there's a middle ground. I'm not saying, I already think we don't have a free market. And I think part of the problem here in a lot of ways, right? Because part of the problem here is I think these investors were responding to conditions that existed then that don't exist now. And that's the real story, if I had to summarize it, right? At the time, they couldn't really make anything in safe kind of fixed income investments. And so that's where they were going into real estate and trying to get returns that now you could get on a short-term treasury, right? And so I think in a lot of ways, this was created by, Fed policy, and things have changed to where now it's not an attractive environment for them to be buying anyway. I mean, if I, as an individual, if it's way cheaper for me to rent than buy right now, and I'm wanting to see that come back to equilibrium, well, it's clearly not good for them, situation for them to be continuing to invest because they're not making the money from it either, if that's the case. And not even to mention where rates are now if they were to go buy new properties. So, I mean, that's really the story to me. The fact that they're selling properties and not just holding is interesting as well, right? They could say, well, interest rates are higher, we just won't buy any new ones. The fact that they're selling is actually a reversal. It's not just holding steady to these new conditions.
And Sean, we got about 30 seconds left. Melody, Jack, do you have anything else for Sean before he goes?
Just on that last one, real quick, I think we have a chicken or the egg philosophical disagreement on it's not a free market, the laws are needed. I would say the reason it's not a free market is because of the laws. The laws are written by the powerful for the powerful, right? D.R. Horton, Lennar, all these firms that we were just talking about have an army of lobbyists for a reason. So any laws that we pass are going to be effectively written by the people we're trying to regulate away from manipulating the market. So I think that, again, more government intervention is not the solution to too much government intervention. That's just my opinion on that.
It's like that Corporate Transparency Act, right, Jack, that was supposed to, you're supposed to now, you can't, you have to be listed as a seller. You can't just be a trust. You have to know who's behind it. But who got a pass on that legislation? The big institutions. And so because the lobbying at the last minute. So.
Yeah.
All right. Well, hey, Sean, again, man, thank you for coming on our show, and good luck out there, brother.
Hey, thank you so much for having me. You'll have a great
Any sign-off words, bro? I'm so sorry. Anything you want to end on before we let you go?
No, you already plugged. Hey, I'm going to be producing more content going further into this. So Ari Watchman, and I'm really grateful for the opportunity. Thank you.
All right, guys, and that, sir, is a wrap. All right. I mean, good guy. I mean, I really, really appreciate. Melody.
So glad we met him. Yeah.
These are all your friends. Honestly, thank you for introducing me to your friends, and
friends.
thank you for being my friend.
Oh,
appreciate that.
Okay.
Appreciate
Is
it.
my mic hot? Someone said it was hot. So
I think they were trolling you. Your mic was on mute, so I don't know why they said that. It was on mute the whole time.
Maybe they know my insecurities about my AV skills. So
you were feeling such fire. You were heating up the whole stream, Melody. That's
right.
what they meant by the hot mic. Yeah.
Okay, got
All right,
it.
guys. All right, so we're gonna move on to the viewers. We're gonna move on to our third story. This is from Melody. This is on China fever dreams. This is gonna be interesting. Here's your screen, Melody, and we are ready.
Are you gonna roll my clip or not?
M to the G, which stands for gosh, guys. OMG stands for oh my gosh, just in case you don't understand. But I'm going to roll a clip real quick on China, and then we'll be right back to you.
Tallest abandoned building in the entire world. This is part of our most useless mega project series. With a towering height of 600 meters, the Golden Finance 117 in Tianjin, China holds the Guinness World Record for the world's tallest unoccupied building.
All right. Okay, so guys, I just wanted to talk about China today, and this is really going to be kind of a core story that we will follow, and we'll do a lot of follow-up stories. And this is really about the property situation unfolding in China that has, it has been going on for some time, but I think it can give us some good context, as Jack was talking at the beginning about collateral shortages, the fact that we are a globally synchronized economy, meaning if one area is going to be impacted, if China's impacted, the US is also going to be impacted. And so I think that's something that a lot of people miss. I think if you go back to the crisis, many people argue that China is the one that got us out of that crisis. And so it's really important to understand what's going on with them right now, and also to understand that it took a long time for these current trends to sort of materialize and what was wrong with these trends. And so I wanted to start with this building, kind of like Jack does. He has a nice little intro to a lot of his stories sometimes, but this is the tallest abandoned building in the world, which is about 200 meters taller than the Freedom Tower or One World Trade Center, which Travis and I actually visited in January, I think. And so I want you guys to think about the Freedom Tower. We'll come back to that in just a second. But this building construction began in 2008. They topped it out. That's where there's always a topping ceremony for these high rises. I don't know if you guys knew that, but it's where they kind of, plant a tree or something at the top. But they topped this in 2015. However, it remains unfinished today due to issues with that developer, due to liquidity issues. He wasn't able to finish it. And guys, the idea behind this building it was built in Tianjin, is that they were going to bring the world's rich and famous to Tianjin which, if you know anything about it, that's not where the rich and famous live. But they were going to create a polo center, so people were going to come because they love polo, and so back in essentially all of these in different ghost cities, these different complexes were born out of, originally back in China, you basically rented your housing from your employer. But when the Chinese decided to actually create a housing market, they probably looked at the United States and said, hey, their housing market is about anywhere from 15 to 20% of GDP. Look how well that works. Let's do that. And so essentially the government started selling those homes to the employees at kind of a discounted price. But us humans are not very original. Anytime, you get into this, oh, I got sold something cheap that I might be able to sell for a higher amount. What happens? The casino is open, speculation. Everybody gets, excited. They decide to build, the world's tallest abandoned building around a polo center. And so this tower is there's nothing there, guys. That it's completely abandoned. And so it reminds me a lot, just coming back quickly, before we get into Evergrande, particularly, when Travis and I were at the Freedom Tower in January, I worked down in every day I had to go underneath the World Trade Center to my office at One World Financial. I know how busy that place used to be. During the week when it was cold, it didn't matter if it was -10 degrees outside, you would go out for lunch. When Travis and I were there, it was completely deserted. In fact, one of the guys that just kind of walks around the park to ask tourist questions came up to us and said, hey, do you guys need any help? And so although you can read news stories about the Freedom Tower, for instance, being 95% occupied, guys, there was nobody there. And so I just want us to keep this in mind for perspective that, something that I kind of encountered when I went on the road in February of 23 was that I would see these abandoned apartment buildings, multifamily buildings that were, huge, over 20 stories, and no one was in them. And when I would make this comparison to what was happening with Evergrande, for instance, in China, people would say I was crazy. And I'm sure somebody's going to say it today, but there was a moment when I was in Nashville, Tennessee, when it hit me that in many ways, we are not dissimilar with what's going on in China. And whether there's one abandoned building we can point to or one ghost city, places like Lakewood Ranch, places like all that commercial in New York City, all that commercial in Dallas are similar to this in that all these multifamily complexes, all of these, high rises were built because we thought there were a lot more rich people than they were. And this is what happened in Tianjin. There weren't rich people living there and no one wanted to come. So I just kind of want to talk about Evergrande and the situation in China for a second, just so everybody gets it. There was a huge population in China, a boom, essentially, kind of, similar to the boomers. But what happened with the one-child policy is now China is on a huge demographic decline. Very similar. We didn't have the one-child policy, but we are also on a demographic decline. Not as much as China. A lot of people talk about that, Peter Zeihan, others, and just what that's going to do to the economy. But just know that between 1978 and 2007, residential per capita space quadrupled. This is huge. This is huge growth. And in many ways, we talk about here in this country, the inventory shortage and the fact that, we needed to meet the demand the millennials would have for housing. And so again, thinking about narratives, we're looking at China right now, but I want you to think about the narratives we hear in the US as well. And so talking about those reforms, essentially China created this housing market out of thin air. We've been dealing with this kind of crazy housing market that's regulated, very institutionalized since the 30s with Fannie Mae, Freddie Mac, FHA, government agencies getting involved in our housing market that has created this very regulated. And that's what a lot of people forget is that the housing market in the United States is largely fueled by the government. Fannie Freddie, the agencies back about 85% of existing mortgages. So just going forward, I just wanted to mention Mongolia because these guys that sort of went out, did the Big Short in 2015 and really understood what was happening in the Chinese market. They were just researching, and what really piqued their interest was a story about a ghost city in Mongolia called Inner Mongolia. And so there was this documentary that Al Jazeera did. So very interesting that Jack's story also centered around Mongolia. Not saying these two things are connected, but I think, very interesting themes. And so this New York hedge fund manager, Parker Quillen, he goes to visit this golden metropolitan. Back in 2015, they put on shorts. They have to exit their shorts because the stock actually, it went up 400%. So, very similar. We've seen XHB, the builder stock here, really get out of control, hit all-time highs. So I want everyone to actually also think about how long these things take to unfold as everyone, I think, is getting very impatient with our housing market and what's going on there. So these guys come and visit. They went to 40 Evergrande projects in 16 cities. Travis, does this sound familiar at all to you? And what they saw is that buildings were unfinished and unsold. So what did they do? They looked, right? This is something that we talk about all the time. People are not looking. They're not looking at what's actually happening. If anybody had gone to that building and toured around Tianjin, they would have said, are you out of your mind? Like, who's going to live there? And this is what Travis and I have been saying when we travel all over the country here in the United States. And I understand people are going to hate that I'm comparing us to China, but I think we're more closely aligned than I think a lot of people think. And so in 2016, they published this report, and it is an expose, and it's showing that Evergrande, for instance, it's just a house of cards. What happens? Again, stock increases 400%. Everybody ignores it. And by the time we hit 2019, the Chinese have about 80% of their wealth in real estate. And you guys might have heard me mention, or others, that really global wealth, 85% of it is real estate. And so this is a huge, you guys may wonder, you're doing a news channel, two of you focus on, real estate. Well, in reality, it is one of the biggest driving forces of the global economy. And that's why. But we also want to share stories, these stories like from China, these geopolitical stories, macro economy stories. So then what happens in 2020? The Chinese come and say, we gotta chill out. We gotta calm down because this isn't going to work, because the way Evergrande sort of got this big was through a lot of debt. Okay. And so Xi has been known to say that essentially something that we say, which is, where you live should not be a casino. But that's a little scary to say, okay, I agree with Xi, but that, that's what he basically has said, the property sector should not be a casino. We are going to have to clean this up now. So a lot of different things happen. They had this three red line policy that was focused around kind of, restrictions around liabilities. And what I want to do, and this is why I say we're going to do a follow story, is I'm actually going to use these three red lines, and I'm going to look at apply it to some of the builder balance sheets here, because I think that's going to be interesting. So again, who is Evergrande? They were a developer. Okay. They were involved in new home construction. They took on too much debt. Okay. So I just want everyone to kind of listen to the themes of this story. And oops, I messed that up. So anyway, from that point, we now have had China coming out and saying, oh, wait a minute, we can't abandon this sector that much. And they have started with some down payment assistance programs, all sorts of ways to try and stimulate the housing market. And so in many ways, this is exactly what we have been doing through our own down payment assistance programs, trying to bring people back into the market to keep it going. And so, again, I just kind of wanted to introduce this idea of Evergrande. We've all heard about it since 2021, but these themes, we're seeing very similar themes in the United States. And just as the government tried to kind of rationalize things, they realized they couldn't. It was too destructive to the Chinese economy. And they've re entered with these down payment assistance programs. Things like if you think about Biden talking about that $10,000 credit for a first time home buyer. So I'll just stop there. Just want to introduce the idea that of these themes that we're experiencing here, looking at China could be a good mirror.
I have some questions for you, Melody. We got some questions starred up as well. First of all, when I was reading that timeline that you made of Evergrande, and I actually cheated, I read ahead, and I think it was like 3/4 of the way down on that timeline, it quoted the Chinese president, and it said he's telling developers, no more borrowing for homes. Homes are to live in, not to speculate on. It's funny how he's saying that now that there's a housing market crash. But anyways, so my question for you, though, is being that, and you mentioned this, being that our economy is globalized, doesn't it make sense for China, Germany, and Japan to have a housing market crash as they are now? Prices are going down on their values. Doesn't it make sense, Melody, that that would have to happen generally with them first, and then it hits the US because we're globalized, because we have world currency? Doesn't that make sense?
Yeah, I mean, it could. I just think that, I do, just like I talk about, Travis, like, real estate is local, but it's also subject to macro things. I think that we can't lose focus on our micro economy and the different actions that the government's going to take to continue to prop up the housing market, because Biden has come out and said, and we'll talk about this in the Real Page story later, that housing unaffordability is one of their top issues that they want to address. And so we're going to see a ton more programs that come our way. But I think what's fascinating is, I think in this cycle, China might be a little ahead of us. And so I think we can continue to watch them and see, did these programs help their housing market? And of course, we don't get all the information from China. We get what they want us to know. And so we always have to take that with a grain of salt. But I would also argue that we get what our administration wants us to know as well, unless we do some digging. But I think if we watch these latest efforts they're making to they're actually having the counties are actually buying properties. This is something I actually talked about in January of 23 that I think is going to happen, is that you're going to have counties getting involved in foreclosures and things like that, because there's just going to be so many abandoned properties. So they're trying to interject in the housing market to save it. So I think watching these efforts is going to be telling for what's ahead for us.
Now, Melody, I don't know if you knew this or not, but I've covered this topic a lot on my channel. And whenever you dare say anything critical of China or the Chinese economy, you get an army of angry Chinese commenters, which is interesting because YouTube is largely banned in China. So I just want to take one moment to send a welcome to all those adorable little commie keyboard warriors who are probably going to show up in the comments at the behest of Xi Jinping to say how full of it we are for criticizing the paper dragon. But thank you, guys. I appreciate the engagement to all you pro-Chinese commenters who are going to show up here. But what I'm talking about here, we've got 65 million empty housing units in China right now, roughly. That was as of a few years ago. Data is hard to come by in China because everything is behind the Great Firewall. But roughly 65 million vacant units. And the way they build, these developers operate in China, is very much like a Ponzi scheme. They pre-sell these apartments. You take out a mortgage on an apartment that's not even built yet. You pay for it. And then what happens is these developers run like Ponzi schemes. They use the proceeds from sales of apartments that haven't even been built yet to build the apartments they already owe. And so that's really what sank Evergrande, because not only do they owe hundreds of billions of dollars, but they owe millions of apartments still. And so China is right now struggling to figure out how to build the 20 million paid for mortgaged but still unbuilt apartments. So they still need to make the problem worse before they can even start worrying about fixing it. And what I have here is showing you China's population. And you can see since the mid-20 teens, China's population growth has been falling. And just 2 years ago, it went negative, and it's still accelerating to the downside because of the one-child policy. It turns out a lot of those stories we heard about things happening to little girls were true. And there's a 35 million male to female imbalance in China. There are 35 million men who will never have children because there's just not enough women. And so the birth rate in China is in free fall. They are in population collapse right now. And this is only going to accelerate because you have fewer and fewer babies being born, and you have fewer and fewer people aging into the job market and the housing market. So not only does China have a huge housing oversupply, but the demand is going to continue to plummet because there's going to be less and less people to live in them. This is a multi-generational problem China has playing out. This isn't just your classic real estate bubble bursting, is the point I'm trying to make here. This is a major demographic shift, a bubble within a bubble within a bubble. And I know that wasn't really a question. That was just me pontificating. But I think most Westerners view this issue through the lens of what we went through in 2008. And this problem is a whole other layer deep than that. This is so much bigger than 2008 here in the States.
Yeah. And I would just add on to that, Jack, is that our demographic picture doesn't look so great either. It's not where China is. Don't get me wrong. But we already have 15 million vacant properties right now that the boomers, we are kind of owned by the boomers. And we're not birthing babies here in the United States the way that we were. And so honestly, you can look at Japan, you can look at China, and you can see what is the future for the United States. And one of the former heads, Jack, of the, he was the deputy head of the Statistics Bureau, said that there was enough vacant homes for 3 billion people. Okay. And so, but to your point, no one really knows. But guys, they don't know here either. That $15 million, $15 million homes, vacant homes, that's from our census. That's from our Statistics Bureau. And I can tell you what I feel and see when I'm out on the road is that we have huge vacancy here already. And, of course, everybody thinks there's an inventory shortage. But I also think that we're not decelerating at the rate from a population perspective that China is. However, we are in a declining demographic picture that no one is talking about when they talk about inventory.
And, that brings me to this next comment here from Charles Melody. Maybe you could touch on this. He brings up a pretty fair point. Now, you already mentioned 15 million vacant homes. We have that here in the U.S. But, to his point, while China and Japan don't have the immigration to fuel population growth, so they will have more inventory ratio wise. They also have a 90% homeownership rate. I believe what he's suggesting is as a result of the immigration here, as compared to China, we have more demand that will absorb any deflation or some of the deflation. What are your thoughts?
Yeah, I don't. So as one thing that I've been telling to people on X Twitter that keep saying, but immigration, they're already here. And so, I've been traveling all over this country. We still have vacancy. Yes, I know a lot of them are staying in hotels in New York,
yes,
but I'm pretty sure those hotels will then be transitioned to permanent apartments. And by the way, they're certainly not going to be buying all the are living in the multifamily luxury. They're not going to be able to afford these new homes, not even with, grants from the government. And so there's 1.4 billion people in China. There's 340 million approximately here in the United States. So they're much bigger than us. But I don't think, the immigration story is they're here. Biden supposedly is going to sign an order to clamp this down. We shall see if that occurs. But we've got plenty of housing, guys. And I know that's hard for everyone to accept, but just drive around and look for yourself.
On the point of population, real quick, if I could, This is very much a global phenomenon, what we just drifted into. It's particularly potent in the Asian cultures. China, South Korea is actually the worst when it comes to the fertility rate. Japan is close behind, along with China. But Europe and the United States absolutely have it too. The global South, South America, Africa, the Middle East, is the only places really in the world, and India for that matter, where the population is still growing right now. So the world population is actually set to decline, even though the World Economic Forum and a lot of those globalists are saying we all need to start eating insects because the population growth is going to explode in the next few years. That is just factually untrue. If we don't all get drunk and start making bad decisions, the world population is going to collapse. So do it for the human civilization, everybody. Drink up and make bad choices. We need to start making babies again. I'm joking, but if we don't start making babies, things will go wrong. All right. Crime rates will rise. Economy will collapse. Labor prices will explode higher because of a shortage of people. I mean, this will be a really big problem.
We got one more comment here, and I apologize to the viewers. I have a cat. Please don't hate me. Okay. I have a cat. It's attacking me right now. It's messing up my equipment. It's very distracting. I love this cat though.
How much do you think that reduces your home price?
I thought you were going to say my respect. I'm like,
one cat.
I've already have reduced respect.
Yeah.
I mean,
one cat instead of 100. Yeah.
It's right here. Okay. Anyways, I love this cat. All right, I'll shut up. So I forgot where we were at. Anyways, comment right here. Yes, comment right here. To the point of immigration, rich immigration, the big building, countries like China or Russia don't understand. They don't understand that capital doesn't have a homeland, nor does it have any loyalty. Rich people won't move to a dictatorship because they know their money is at risk. What do you think about that, Melody?
I say we turn that, and I say let's look at what happened after February 2022 when the United States started, basically seizing Russian assets and deploying them against another country. And so I think that too, you can apply that again to the United States to some degree, is that the rich in certain areas of this company no longer feel that the United States is a safe place to park capital because of the fact that the US government willy-nilly just went out there on the global stage and seized these assets. So I think, yes, I would agree. But then too, I often get when I talk about China, this whole story about, well, the rich they're fleeing, all their money's coming to the United States. Sure, I think there is a component of that, definitely. But also there are plenty of loyalists to the Communist Party, and they will do what the state tells them to do no matter what. And they will park their capital where the state tells them to park it. And so I think we just have to, I know it's difficult, but we have to understand that there's multiple themes that could happen at the same time, and that the state is much bigger than this, handful of the global ultra rich. And so we can't rely on that capital. And yes, I think largely during the banking crisis, a lot of the Chinese were saved at SVB because of their political ties. I mean, there are a lot of people in our government that have very close ties to China. But I think largely the state does not trust the United States anymore. And the state is going to dictate the majority of where capital is going to go.
Okay. Anything you want to add, Jack?
I would add that capital is mobile. Capital is not fixed in place. And China does have a capital flight problem, which they have done very well to crack down on. There has been the purchases of real estate here in the States. I do think that's a little overblown. But the Chinese cracked down very hard on crypto over the last few years. A lot of capital was fleeing China in the form of cryptocurrency. They have since cracked down on that. The U.S. is helping with the KYC laws. But China has recently shown a lot of interest in gold. And although they slowed down their gold purchases, they didn't buy any gold in May at their central bank. But there's been a lot of flow from west to east of gold and silver over the last few years, because the average Chinese household has 90% of their wealth in real estate. It's not like here in the States where the average middle-class family is pretty evenly split between housing, stocks, and bonds, right? You've got equity in your home, and then you've probably got a retirement plan that's in like a 60-40 bond stock portfolio. So the average middle-class family is pretty spread out across housing, stocks, and bonds. In China, it is 90% housing. I mean, China is so overexposed to real estate, it is ridiculous. And now the average Chinese is losing confidence in that real estate market. They don't trust their stock market, so they're hiding in gold. So this story about the Chinese real estate collapse could be a major headwind for precious metals in the years ahead.
And we're
And,
running
and
out
it
of
might
time.
have that you
No,
know,
go,
and
Melanie,
it might
go.
it might have some connection to the Trafigura story as well. I mean, you know, what's happening with those commodities. Anyway, go ahead,
Trafigura.
Trafigura.
Trafigura, whatever. Yeah.
Can you say toy boat, toy boat, toy boat, toy boat, toy boat 5 times fast?
No.
Yeah, don't even
Not-
try. I
right.
can. Okay, so I got you.
Good.
All right, you guys, that, my friends, is a wrap. We're going to move on to our fourth story because I'm really, really looking forward to this story. We've recently got unemployment numbers. Obviously, it went to 4, but we got all of these jobs. So what Jack is going to do is he's going to rip that sucker apart. And I actually have a little bit of insider on this because Jack and I talked, I think, was it yesterday evening?
It was.
And so there's some juicy stuff. Jack, take it away, brother. I am definitely looking forward to this.
The strong jobs market, right? Oh, it's so strong. The tight labor market. We hear so much about it. Trav, you got the wrong screen up there, brother. We've heard about this for years. All right, you can free clips of people just saying the strong jobs market, the strong labor market, resilient. It's fake. All right, it's not true. Case in point, have your wages gone up to keep pace with inflation? You, the viewer? Almost certainly not. And if you're lucky enough to say yes to that question, then God bless you. But for everybody else, the cost of living has gone up more than the cost of labor. So that one data point right there tells you that this image of the strong labor market is bunk, because labor doesn't get cheaper relative to goods and services if labor is in short supply, right? If there's a supply-demand imbalance in labor, labor would be getting more expensive than other stuff, but it's not. It's getting less. So we have been lied to about this strong labor market, and we got a lot of data this week that supports that, all except the one data point that everybody was talking about yesterday, the 272,000 jobs that we added. That one data point that points to a strong labor market, which we're going to show later, is BS. Everything else is screaming that the job market is not as strong as they're telling us. Let's start earlier this week. We got this one at Bloomberg. All right, we've got U.S. payroll gains not as robust as reported, the BLS data suggests. They're saying last year they overestimated by 60,000 jobs a month in these non-farm payrolls report. And the job market is weaker than the Fed thinks. The U.S. job market may be a lot less vibrant than Federal Reserve Chair Jerome Powell and his colleagues seem to think. And I would add that there are 400 PhDs working at the Federal Reserve. Do we really believe that all 400 of those PhDs are wrong, or are they just not telling us the truth? Maybe some guy on YouTube knows more than 400 economic PhDs. Maybe that's possible. Or maybe they're just intentionally ignoring the data that doesn't support what they want to tell us. Data published Wednesday by the Bureau of Labor Statistics suggests payrolls might have grown by about 60,000 less per month on average last year than the roughly 250,000 run rate derived from the agency's monthly employment report. And Bloomberg is understating this here because the actual data said that in 2023, they overstated the jobs by 730,000. The headline was we added 2.7 million jobs in 2023. And now this data is saying, whoops, we overstated that by 730,000. So almost a quarter or more than a quarter of the job gains of last year never happened. And so they're saying here there's a pretty good chance that the establishment survey has been really overstating the condition of the labor market. That's according to Barry Knapp, the founder of Ironside's Macroeconomics, who said the monthly payroll numbers, the job market is weaker than the Fed thinks. Now, we got more data this week that says the job market is weaker than the Fed thinks. We get the job openings number. We had that on Wednesday, I believe. The job openings and labor turnover survey, also known as JOLTS. It's a very little known data point. Some people follow it. Most people are unaware of it. But the number of job openings in the United States declined by 296,000 from the previous month, down to 8,059,000 in April. That is the lowest number since February of 2021. So we had 300,000 job openings went away last month. Now, this is a chart showing U.S. job openings going back to 2019. Now, I want to, obviously, you're probably noticing right away that big bump that we got in 2021, right? This huge lurch here. And I don't think those were real job openings. And a lot of people are starting to agree with me. I've been talking about this for about 2 years on my channel. I did an interview with a guy from Twitter. It's called The Happy Hawaiian, who made a fantastic presentation about how this whole spike in job openings was fake. This was the advent of work from home when this big spike happened. And when work from home started becoming a major thing, one job started to be posted in every city around the country. Because if somebody can do this job from home, then you can post it in New York, Chicago, Los Angeles, Detroit, everywhere. So you've got one job posted everywhere. It created millions of job openings out of thin air, but there wasn't really a job behind every one of those openings. And for years, we've been pointing to all of these job openings saying, look how strong the labor market is. We peaked over 12 million in March of 2022, which coincidentally is right when the Fed started raising interest rates and quantitative tightening. And you can see since that peak in March of 2022, this thing has been falling fast. Now, the problem is it's still higher than pre-pandemic. So a lot of people look at this chart and say, well, there's still more job openings than there was before the pandemic, and therefore the labor market is still tight. But remember, this whole big spike was fake. And at the rate this thing is dropping, if you account for that spike, there's actually fewer available jobs now than there was pre-pandemic. So the labor market is already very loose, very weak. And then, of course, we got the jobs report, and everybody was bloviating about this yesterday. U.S. adds a much better than expected 272,000 jobs in May, but unemployment edges up to 4%. Now, there were some interesting things in there. And keep in mind, guys, a 0.1% increase in unemployment is about 160,000 people. All right, so you can kind of quantify this a little bit. So the economy created 272,000 jobs. So that's about almost 0.2% more people working. The participation rate fell from 62.7 to 62.5. So 300,000 people dropped out of the job market, and therefore they're no longer counted as unemployed. And yet the unemployment rate rose from 3.9 to 4.0. So those statistics right there, those three things, that the labor force participation rate went down, unemployment went up, but we supposedly added 272,000 jobs. One of these things is not like the other. Those 272,000 jobs, that number is BS. All right. Now, there's two different surveys within the unemployment report, within the jobs report. And the reason why I think that 272,000 jobs is fake is because of the two different surveys. All right, they're called the establishment survey and the household survey. Now, what we're looking at here is the unemployment rate. You can see it's risen steadily over the last year or so. Now, with the establishment survey, that gives us the headline number, how many jobs were added. They call up establishments, they call businesses, and they say, how many people are working there? Did you hire somebody? And the businesses are saying, yeah, we hired 272,000 people. Now, then there's the other half of the jobs report is the household survey, and they call up people and they say, are you working? And if you're working, are you working full-time or are you working part-time? And we have got a huge disconnect between the establishment survey and the household survey. Now, to do that, we're going to go to figure out what's going on, what's behind that big deviation. You actually have to go into the weeds. We're going to get data heavy here. This is the actual non-farm payrolls report, or the employment situation summary that gets released by the Bureau of Labor Statistics. And of course, they always start with the headline number, the 272,000 jobs that were added in May. That is from the establishment survey. But I want to go into the household survey. That's where the good stuff is. So I scroll down past all of the talking points. My favorite thing to do when these jobs numbers come out is go to table A9 in these reports. I know we're getting a little technical here. All right. But in table A9, they actually break up the employment statistics. We're going to focus on the seasonally adjusted numbers from April to May. I know seasonal adjustment, some people have an issue with that. It's the best data we have. We have to go with the numbers they give us, unfortunately. We can't invent our own data points. But if you scroll down past all of these age and gender demographics, you get into full or part-time workers. And this, I think, tells the best story of the economy, of what's actually going out. Right here, you've got the number of people who are working full-time jobs in April in the United States. and it was 133,889,000. This chart is giving us numbers in thousands, so that's 133.8 million. Now, in the May report, we had 133,264,000. That means the U.S. economy lost 625,000 full-time jobs in the last month. That's full-time jobs that come with benefits and paid time off, vacation, you're home with the kids at night, right? Full-time jobs, 625,000 lost from April to May. Keep in mind, they're telling us 272,000 jobs added. So right away, something doesn't smell right here. Now we're going to go to the part-time workers. And this is where we get a little bit different. In April, we had 27.718 million part-time workers. And now we have just over 28 million part-time workers. So we added 286,000 part-time jobs. And guys, this has been the trend for like the last year and a half. We have been losing millions of full-time jobs, well-paying, benefits-added jobs, and we have been gaining these BS low-paying part-time jobs by the millions. And all the while they've been saying the economy is so good, the economy is so strong. It's obviously not. When people lose full-time jobs and have to go be a barista at Starbucks or a greeter at Walmart to make ends meet, that is not a good, strong economy. That is not a strong labor market. That's desperate people doing whatever they have to do to make it work. And you can see that even more in this category in Table A9, the multiple job holders. In the month of April, we had 8,383,000 multiple job holders. And in the month of May, 8,399,000. So we've added 16,000 more people had to go get a second job in May. That's not economic prosperity. That's desperation. Now, 16,000 versus about 8.4 million, that's kind of a rounding error, but this number has risen by more than 1 million since last year. More than 1 million Americans have had to get a second job because the cost of living has risen faster than wages. Again, that doesn't happen in a strong labor market. That happens in a weak labor market. And the last thing I want to point out is self-employed unincorporated. In other words, that's your gig workers, your Uber and Lyft drivers, right? Self-employed unincorporated went from 9.952 million to 10,065,000. So we added another 113,000 gig workers. So let's take all this in aggregate, all right? While they're telling us the hot jobs economy and we added all these jobs, we lose 625,000 full-time jobs in the household survey. We gained 286,000 part-time. 16,000 more people had to get a second job, and 113,000 people are driving Ubers. Does this seem like a strong labor market to you? This is nowhere near a strong labor market. This data is screaming weak labor market, higher unemployment just around the corner. Now, I know a lot of people are probably talking about this, and this is a sensitive subject, but I just want to remind people what we talked about last week, how the screamers dominate the conversation on immigration. Let's try to tone that down a little bit. But in Table A2, we get a little bit more clarity on what's going on in the economy. Now, let me just go to the right place here. Was it A? Oh, I'm sorry. It was Table A7. Wrong table. Table A7. All right. Now, what we're doing here is we are talking about unemployment levels among people who are born in the United States, native born, and people who are not born in the United States, non-native born. Now, I just want to also add the caveat that non-native born, that also includes foreign-born U.S. citizens, all right? And that also includes legal immigration, and it includes undocumented migrants, illegal immigrants, all right? So this is not an apples-to-apples comparison when a lot of people are saying it's all the illegal immigrants are taking the jobs. When we say foreign-born, that does include a lot of U.S. citizens and a lot of legal immigrants. So keep that in mind. But we're talking about year-over-year changes here now. Now, we got some really interesting year-over-year changes. Let's start with the native-born. Or we'll start with the foreign-born numbers here. All right, people not born in the United States. Again, not necessarily illegal immigrants. All right, the population of foreign-born people in the United States in May of last year was 46.769 million. This year, it's 48.311 million. So we have added over 1.5 million foreign-born people in the United States. Immigrants, legal and illegal, and U.S. citizens who were born in other countries. 1.542 million higher. Now, the labor force among them has gone from 31.249 million a year ago to 31.989 million. So that's a gain of 740,000 foreign-born workers in the United States. So that the labor force participation rate, by the way, has gone down a little bit from 66.8 to 66.2. So some of those foreign-born people have dropped out of the workforce. But now look at the employed. The number of employed foreign-born people in the United States has gone from 30,259,000 to 30,896,000. 637,000 more people working versus last year that were not born in the United States. And lastly, the unemployment rate among foreign-born people has gone from 3.2% to 3.4%. So the unemployment rate is rising among this demographic. But you're seeing, guys, population growth of 1.5 million, labor force growth of 740,000, and then the actual employed number of people growing by 637,000. Foreign-born people are doing very well in this labor market. They are gaining jobs. Now let's talk about the native-born people born in the United States, U.S. native-born citizens. The population for native-born people has gone from 219.849 million to 219.937 million. So it's grown by 88,000. So the population of native-born is growing just barely by 88,000, but contrast that with a gain of 1.5 million for foreign-born. That's what we were talking about in the previous China segment, how if you take away immigration, the United States has the same fertility problem that they have, maybe not as bad in China, but it's still there. And then the civilian labor force has gone from 135,453 to 135,587. So we've actually had a gain of 134,000 in the workforce. But again, contrast that with a gain of 740,000 in the foreign-born workforce. You can see how the demographics are really favoring the foreign-born workers here. Participation rate among the native-born has been unchanged at 61.6%. Now look at the employed number, and this is where I think people are probably going to get a little bit angry here, but the numbers are the numbers. The number of employed native-born people in the United States went from 130,744,000 to 130,445,000. So that is a loss of 299,000. Almost 300,000 fewer native-born Americans are working right now versus a year ago, while almost double that, or more than double that number, 637,000 more foreign-born people are working in this country. That is a swing of almost 1 million people. And you see now how the immigration story is, yes, it is affecting the labor market. And of course, the unemployment rate has risen more for native-born populations than foreign-born populations, from 3.5 to 3.8%. So we've got this big deviation between the household numbers and the establishment numbers. All right. When you call up businesses, we added 272,000 people. When you call up people, you get 600,000 of us lost full-time jobs, and maybe a third of us got part-time jobs. So there's obviously a big disconnect between the people and the businesses. And I wonder, the people that they're calling, does that include the 1.5 million foreign-born people who have come into this country who are now participating in the workforce? I don't think it does. So immigration is absolutely playing a role in the labor force, in these jobs numbers, creating this big disconnect between the two surveys in the unemployment report. And that's absolutely playing a big role in why wages are not rising as fast as the cost of living, because while the price of things is going up, typically people would demand a higher wage, but we are importing labor supply. And when you import more supply, you suppress the price. And so wages are being held down both by interest rate hikes and quantitative tightening at the Fed, but also by the mass importation of cheap labor that is preventing wages from rising. You can see it in Table A7 and Table A9 in that report from the Bureau of Labor Statistics. And that is why we do not have a strong and resilient labor market.
Melody,
Great job. Yeah, excellent, Jack. So, Travis, if you could just bring up this. Yeah. So, I just wanted to touch on something you're talking about, Jack, which is the labor participation rate. And, this is one of the reasons why I think we've been in a silent depression. And since 2007, really, a lot of things going on globally. But if you look, really, we peaked in about 2001 when it came to a participation rate. And you can see it has steadily started to come down. And a lot of this, I believe, has to do with folks feeling like they cannot find work that could sustain their existence, and they've sort of given up and they've done a lot of the gig work, things like that. But still, there's folks out there that talk about the 2 million missing men from the workforce. Some people have said maybe they're staying home to take care of, children, which that's awesome. But I can tell you of the people that I know and talk to around here that aren't in the labor force, that is not it. They don't see a viable path. A lot of people are living at home longer. And a lot of people in their basement playing video games. I mean, it's just, and by the way, that in some countries, like the Philippines, people they do pay to play video games, and that's actually their job. But I just want everyone to kind of see that in reality, the economic situation in the United States has not been great for some time, but there has been a concerted effort in sort of hiding what's going on by looking. I mean, you can remember, Jack, probably in 2018, they're talking about the strong labor market then. And really that was, again, services jobs. So I guess my question would be, what jobs do you think that these foreign-born workers are taking? And what do you see in terms of trends there?
I don't have the data on hand to support it, but my gut tells me they're taking more low-skilled labor tasks, right? Obviously, a lot of agriculture, and that does kind of feed into a lot of the common criticisms, or maybe some of the things we've even seen in the comments here, that we need this importation of cheap labor in order to keep prices down. Well, how's that working? Are prices being kept down? No, they're not. Prices are still going up. But what's not going up is your wages. So when they say we need these people to come in to keep wage inflation from happening, well, that's like saying we need to keep hurting poor Americans to the benefit of rich Americans, because who benefits from this cheap labor? It sure as heck isn't the American middle class. It sure as heck isn't the American lower classes. No, it's the ownership class that owns the businesses that are selling at higher prices while their labor costs are being held down by the importation of cheap labor. So, that whole we need this to keep wages from going down to stop inflation, that is BS. That is making the inflation felt by the average American worse because his wages are being suppressed. And the other thing is that, we need to bring these people in because these are jobs that Americans won't take. Well, look, I've worked some really rough jobs. I've been a commercial fisherman. All right. I've done manual labor before. The price was right. And so I was willing to put my butt on the line on a boat and do that menial work because I made good money doing it. And if we didn't have this flood in just the last year, guys, 1.5 million people, maybe the price of the labor to do that job would rise to a point where an American was willing to take that deal, because wages are a transaction. It's a mutually agreed upon deal. You agree to sell your time for money. And right now, because we're importing all this cheap labor, the wages in these jobs are being held so low that Americans won't take it. But these people coming into the country will. Well, maybe if we didn't have that big importation of cheap labor, the wages would be forced to rise by supply and demand until Americans were willing to take those jobs. And then maybe we wouldn't have such a problem of cheap wages in this country.
And one of the reasons that the 80s are so different to today is that you had women joining the workforce, which really, because a lot of people have been arguing that's why, they have said that home prices didn't go down in the 80s, when rates were rising, whatever. But in reality, you had women joining the workforce. And I think what you're seeing here is the opposite, and not necessarily women, but both women and men understand that nurse, like if you pay for childcare, that's going to wipe out all of your wages. Like you're not going to make anything. You're going to be net negative once you realize, okay, I've got to pay for childcare, I have to pay for gas, you know, I have to buy my work clothes. And so in reality, we've created this upside down situation where people are leaving the workforce because it's more expensive to work.
Absolutely.
right.
I mean, the price of the price of childcare went up so much in the last few years. But again, because we've imported all this additional labor and because the job market is not that strong, people are leaving the labor market because the childcare exceeds the cost of the wage you would earn by paying that childcare. So people are leaving the workforce. And well, that's going to create a shortage of labor, which will force those wages to go back up in order to convince those people to re-enter the workforce. Unless you import millions of new labor supply, then that doesn't happen. And that's where we get this situation.
So I kind of have a little bit of a different focus on the data that you presented because I'm noticing a trend, Jack, and it's very disheartening. It's actually very depressing, and that's data revisions. The data revisions appear to be a trend now. It appears to be a trend where the establishment is hiding the bad stuff. And I say that because the data revisions are almost 100% of the time to the downside. It's worse. And so I want to reiterate for the viewers what you just said that hit me like a ton of bricks. First of all, you said for 2023, there were 730,000 jobs that were revised, that went away. Is that correct, Jack?
Yes, but that wasn't the monthly revisions to the prior jobs numbers that
was the
we
whole
were
year.
used to. That is also going on. But this is the BLS went back and looked at the entirety of 2023 and said, whoops,
right.
we overstated by almost 750,000.
My point is, though, that was, like, as you said, that was a 25% reduction in jobs. Essentially, what I'm trying to point out, we can't trust the establishment. And I also want to mention that you also said that, first of all, the headline is the establishment survey. The headline is not the household survey. The establishment survey said somehow, this will be revised, there's a trend, that there was an increase of jobs of 272,000. The market, sent the 10-year shooting upward. They're like, oh my gosh, the labor market's hot. But when we compare the establishment survey to the household survey, where now citizens are completing the survey, it doesn't say that we had an increase in jobs. It says, when we do the math, that there was actually a decrease of 300,000 jobs. The discrepancy is over 500,000 in 1 month. In 1 month, the discrepancy is 500,000. And so, to me, Jack, that's suspicious, man. That's suspicious. We have an election year. We're seeing multiple data points revised. I mean,
Travis,
I'm not trying to,
exactly why we started this network. All right, the establishment survey and the household survey. When you talk, I'm not trying to wear,
Jack. I'm not trying to wear a tinfoil hat. All right, I don't want people to think I'm just some doomer. I'll wear a doomer shirt, but like, my God, Jack, how could we not? I'm starting to think. You want to know who wears the tinfoil hat? It's the bulls. It's the bulls that are not the realists. We're realists. When someone keeps revising data and keeps tricking the way I'm thinking, I don't trust them anymore. I don't want any part of it. And so my question to you, Jack, why are they able to get away with this? Why are they going to, why can they,
who benefits? Who benefits, Travis? The ownership class benefits from this, right? Again, the telling everybody everything is great in the labor market, even though wages are being suppressed, that benefits the people who own the businesses, the people who own most of the stocks and the assets. All right. And you see that when you turn on CNBC, everything is great. You see that in the establishment survey when they talk to businesses, we're hiring all these people. And then, of course, you talk to people, actual, Americans living on the ground in the real world, and you get a totally different scenario painted, because that is the experience felt by the average person is nowhere near what they're describing in the financial press. It's nowhere near what the establishment survey is saying in the non-farm payrolls report. It's closer to what we're saying here on DNN and to what we see in the household survey, where hundreds of thousands of people are getting laid off from full-time jobs and having to go work at freaking Starbucks and Walmart to make ends meet.
I mean, but the headlines say everything is great. So we got to, technically we only got 60 seconds. We'll run a little long because some of these are really great questions, Jack and Melody. So here's one from Brojo, Gen X, the BS. Creative name. Anyways, he's saying part-time versus full-time seems relative. And I want you to educate him, okay? I want to, but I'm too fired up because I'm really, how the hell are they doing this? Excuse me, my language. You can work part-time, but make equal or even more money. We're just talking money than some full-timers. Jack, is that true?
Brojo's right there. All right. You can, especially when we're talking about skilled trades. And look, we're all talking about student loan forgiveness right now. So there is a transition happening in the labor market where college degrees are becoming less valuable. White collar jobs are going away and the skilled tradesmen are overtaking them. So if you're in a trade working by the hour, especially when you factor in overtime, Brojo's right. You might be making a lot more money than that guy with a liberal arts degree who gave up on his category and now he's going to teach or something. But on top of that, I would say that's not what we're seeing in these jobs numbers. The biggest category for the last year and a half has been leisure and hospitality. We've added part-time jobs in leisure and hospitality. That's restaurants and hotels. Those are not skilled tradesmen. So yes, Brojo's right. You can, if you pursue a career in the trades, you can make more than your full-time counterparts in part-time work, but that's not what most people are feeling right now.
There's a but there. And I'm hoping Melody is going to now, Melody, what do you think about that?
Sorry, I was on mute. No, I would agree. And so, I mean, the services sector is not where, you're going to make a lot of money. You're going to have to work 3 of those jobs. And so I would agree. Like Jack is saying, I do think the labor market is changing. And I do think those who initially had liberal arts degrees like I did, that's why I raised my hand, are going to suffer. And we're moving more toward, I think, people who do get educated in a trade are going to be better off than white collar jobs because AI is coming for a lot of those.
But what I was hoping that because and this is no knock to Brojo, I'm assuming he's a little bit younger. All right. I'm older. I'm not speaking for y'all. I'm an old man. All right. My body tells me it every single day. No one's mentioning the medical. No one's mentioning the 401k matches. No one's mentioning the fact that you can't really retire part-time. We retire at full-time places that are matching our 401ks, that are taking care of their employees, and that's not what you get with part-time work. No one's mentioning that. Yeah, we could make as much money. Money is good. But have you seen the medical costs? You know how much it costs for medical for my family? Over $1,000 a month for medical. I want someone to pay for that. Will you? We have a new business. Will you guys pay my medical for me? This is a new business, right? You will not do that? Well, that's messed up. But my point is like,
thoughts and prayers.
I
wish you luck. Thoughts and prayers, but no, I won't pay your medical. Sorry.
All right. Well, I got one more question and then we'll go. We're running a little bit back on this one. This is actually very interesting. This is from Michael. This is what he's saying. Population growth and economic expansion, I think is what he said, go hand in hand. You lose one, you lose the other two. What do y'all think about that?
Yeah, I mean, hey, GDP is your GDP per capita times your capita, right? And if your capita is dropping, unless your GDP per capita is going up, your GDP is going to fall. So absolutely. Population decline is going to hurt GDP big time, especially in China.
All right. Very good. Very good. All right, you guys, let me get this off of here. We ran a little bit late and y'all, thank you for watching this video. That is a wrap. So we're going to move on to our next story. What story is this? Story number 11 or we're on story number 5? All right. So I'm going to do story number 5. You guys, this story, I got a 2-part to the story because the story is going to be on generational home unaffordability. And we're going to take a look at like what Gen Zers are looking for in a president and then what are boomers. You guys, it's all over the place. And then I'm going to give hope to the Gen Zers. If you're a Gen Zer, you're watching this, you're like, oh my God, America robbed me. They stole the American dream of home ownership. I got some hope for you. And that's how I'm going to end this video. I'm going to show you what's going to happen the next 5 years based on historical trends. And I'm really looking forward to that. So I hope you guys like it. Let me get started here by, actually, I have to share my screen. Just bear with me 1 second, you guys. Here we go right here. And I'm going to switch cameras. So we're going to start by taking a look at this article. And then I'm going to go into some, again, like I said, some affordability stuff. And then I can't wait to break down the income versus home price growth that I've been researching. But the name of this article is Housing Affordability is Gen Z's Top Voting Issue. Reason is, I'm going to tell you guys right now, is because Gen Z, they took the hit the most. I mean, imagine being a young adult right now. I mean, you cannot buy a house. It's almost impossible to buy a house right now if you're a young adult. Think about that. Think about what anxiety and depression and loss of hope, loss of identity these young adults have. I mean, it's a real thing going on. But again, you guys, there is hope. I will show you that. But a couple things I want to point out here. Now, this article is saying millennials, Gen Xers, and baby boomers all ranked the overall economy as the top issue, but not, again, what I'm saying is it's not Gen Zers. This goes on. More than 9 in 10, so 91% of adult Gen Zers say housing affordability is important when considering who they will vote for in the upcoming presidential election, making it the top issue for that generation. Okay, so Gen Zers were more likely to rate housing affordability, again, as the most important factor. But what I want to show you guys is what happens when, with the age groups. This is actually pretty incredible. So this has 4 different columns, obviously different rows, and the rows are ranking what's more important. But each column represents an age group. The first age group is Gen Z, second is millennials, third is Gen Xers, and the fourth is those crappy baby boomers. I'm just kidding, baby boomers. I'm just jealous. You got a ton of opportunity that I wish I had. A little jealous, but I'm just joking, okay? So look at this, guys. Again, the young adults, the priority, let me zoom into this real quick, okay? The priority, zoom in a little bit more here. Jackie requested that, right? Like zoom in. So the priority of Gen Zers for presidential election, this is on the young people's minds, housing affordability, number 1. Now, millennials, Gen Xers, and baby boomers all have the same priority, the strength of the overall economy. Now, strength of overall economy is next in line for Gen Zers. But take a look at this, you guys. What I want to say is as you get older, housing affordability is less important to you because you've already made your money. Again, it's the younger kids that are really, really suffering. And you see that when we go over to millennials, housing affordability drops to number 3. When you go to Gen Xers, housing affordability drops even more to number 4. When you go to the baby boomers, they're like, housing affordability, why do we care? We own 4 houses free and clear, right? So their housing affordability is all the way to number 6. So I thought that was interesting. I don't know if you guys think that's interesting or not, but also what's interesting is preserving democracy. The younger you are, the less preserving democracy matters to you. Probably because they don't trust democracy. Think about it, guys. How could Gen Zers trust democracy in the world that we're living in right now? I mean, not to mention just the inflation, but the data revisions. I don't trust the democracy a lot of times. So again, the younger you get, the less that's important to you. Very interesting for both Gen Xers and baby boomers, preserving democracy was the second overall pick. But when we get into the younger millennials and Gen Zers, look at this. It goes so far down. For millennials, that's the 5th concern. And actually for Gen Zs, here we go right here, 6th concern. In other words, what I'm trying to explain to the viewers is everyone, for the most part, is concerned about the housing market. And generally, the younger you are, the least amount of hope you have. But again, I'm going to end in hope. I'm going to end this video in hope. But I want to go in and touch in why the housing market is so unaffordable. So many people get this wrong. They're like, it's because of interest rates. Well, it's not just because of interest rates. Okay, remember how payments are calculated. It's both interest rate and price. And it's the price that is dooming us. The interest rate they can play with. They can go up, they can go down, but it is the price that's killing us, guys. And take a look here. This is from Black Knight. Now, what you guys are looking at here, I'll be very quick, and then we're going to go into the really good stuff. This is the national payment to income ratio. This is not counting taxes and insurance. So these numbers are much worse because we have a situation right now in the housing market where we have never experienced such skyrocketing homeowners insurance and skyrocketing property taxes. Hopefully you're not in a metro area like I am, where I'm getting hit by both. So that's not in these numbers. And this counts a 20% down payment. All right. Most down payments are not 20%, but that's what this is counting. This is saying the level of unaffordability is basically the highest it's been since about the 1980s. And I'm going to show you what citizens were going through in the 1980s, and we'll make that comparison. But again, you guys, If you're going to buy a house right now, you're going to be married to your mortgage payment. And as someone that used to be married to a mortgage payment, I got to tell you, that relationship goes downhill real fast. Real fast, that goes downhill. Okay. You don't want to be married to no mortgage payment. You want to be married to someone that you love, you're friends with, you help each other grow, blah, 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 blah. But that's the prices. Okay. That's the interest rate. That's what's happening as far as interest rates. Look at prices. Again, I show this all the time. The PE ratio went up even higher to 7.68. So we have 7.68 years it takes to pay for a house. The peak of the bubble, according to this data, was under 7. All right, going back to the 1970s, again, you want to compare 70s and 80s, just look at the price to income, okay? The PE ratio, nowhere near what's going on right now. Nowhere even close. You cannot compare the 70s and 80s to what's going on right now. It does not work. And so here's the hope, you guys. Let me switch here, okay? Here's what I've been saying. Okay, there's all of these, debates and, disagreements. This matters, that matters, inventory, supply, demand, blah, 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 blah. But I will say the primary factor that bulls cannot explain, okay, every single one I've talked to cannot explain income. They can't explain how people are going to play this or going to pay for this. They cannot acknowledge sustainability. They can't acknowledge how important income growth is. But when we go back into the space-time continuum of the history of the United States, we see actually income is vital. Let me show you guys. All right. So this is what I'm going to do. I'm going to try to do a different format here like this. All right. But I'm going to put this. Hi, Jack. How are you? Okay. And you know what? I'm going to do something special. Here's what I'm going to do. So you can still see me. Look at that. Oh my gosh. Look at what I'm doing. Oh, how did I do that? Pretty cool, right? That's what $10,000 gets you right there. You can move your picture around. You guys want to buy this from me? I'll sell it to you for deflationary. Okay, whatever. Anyways, guys, take a look at this. This is absolutely insane. And then I'm going to break this down into half decade. What you're looking at right here is home price growth. Okay, let me see if I can circle that. Home price growth compared to income growth based on a 10-year history. So you're looking at a decade. Essentially, what you're looking at is the 1980s, 1990s, 2000s, 2010s, and 2020s. So again, guys, you're looking at the decade picture. So let's compare the 1980s. All right. The 1980s, massive home price growth. You guys are right. Massive home price growth. All right. Look at that. It had 65% home price appreciation during the 1980s. But you guys see that big black line right there? You see that? You guys know what that is? That's income. What I'm trying to explain to the viewers, to any bulls that are watching this, is the income growth during the 1980s outpaced home price growth. It outpaced, you guys, this is important. It outpaced home price growth. We had income growth of over 70% during the 1980s. Fast forward to the 1990s. Look at same thing in the 1990s. In the 1990s, you guys, we had a more income growth than we did home price growth in the 1990s. And the reason that is because income growth is super important. In fact, the only time where that switched was right here. Guess what happened in the 2000s, guys? The great financial crisis happened. And wait till I break this down into 5-year increments. You guys are going to be blown away. But look at this. Basically, what happened is the first part of the decade of the 2000s, home appreciation skyrocketed. The second half of the early 2000s, home prices went down, and so you have this closer equilibrium. Without the second half of the 2000s, that chart would not look like that, is the point I'm trying to make. But let's get real juicy here. Okay, we're just going to look at half of 2020. Look at this. Okay, you see that? You see the massive differential between home prices, guys, and equity? You guys, we are so... How are you going to pay for it? How are you going to pay for it? You don't have the money, and that's not even adjusted for inflation. Look at how backwards that is. Breathe this in. Breathe this in. This is, in my opinion, the biggest factor is the income. If we had income growth match home price growth and we all made 50% more money, then all right. No housing market crash. Okay, we're not going to crash. All right? But that's not what happened. And I'm going to show you guys. Let me break this down real quick to the 5-year increments. And you guys, I think, are going to be blown away because here's the hope. Here's the hope. If you're a young person, if you're Gen Z, or you're like, I'm never going to buy a house, here's the hope. I'm going to show you what happened. Okay, look at this. This is 5-year increments now. Look at this. This is right before, on 1 minute, guys. This is right before the great financial crisis. Look at this 5-year, this 5-year period. Okay. During this 5-year period, home values went up like crazy. Okay. Income barely went up at all. Okay. During that 5-year period. Let's fast forward to 2020 through 2024. What do you guys see? And I want to remind you that this is really the only time in history, by the way, at least going back to the 1975s. We had almost the exact same thing happen in 2020 for 2024. And again, what I'm trying to ask is what does this look like when we adjust for inflation? How much worse is 2020 to 2024 when we adjust for inflation? Now, here's the thing. Here's the hope, Gen Zers. Look at what happened in 2005 to 2009. Okay. These people right here paid for the price appreciation. They paid the last 5 years of the decade. Okay. So the first part of the decade, everything was out of whack. Home prices went up too much. Income didn't sustain. People stopped making payments. Housing market crashed until income caught up. And then we have 2010 to 2014, a lot more normal. 2015 to 2019, a lot more normal. And then boom, look at what just happened now. So what I'm trying to explain to the viewers is don't worry, guys. The next 5 years, 2025 to 2029, if history repeats itself again, this is what it's going to look like. House prices are going to go down as wages continue to catch up. We have to have wages catch up to the values of houses. That's how things are sustained. We know that because we can reference the 1980s. We can look at the 1980s and say, yes, massive home price appreciation, 60%, 65%. But we would be naive. We would be naive if we don't acknowledge that income growth exceeded that. Whereas today, it is very far from that. In fact, right now we have quantitative tightening going on. The Fed doesn't want some wage price spiral. In other words, the government is making sure we don't make more money. And so that is the story I have for you.
So Travis, that was an excellent piece, excellent visual as well, because I think we've seen a lot of people on X Twitter try to talk about the 80s in terms of a home price acceleration period. But I think that harkens back to what I was saying about that income was rising because you had women start to participate in the labor force. And so I know you've had some bulls on your channel. I try to go on bull channels to talk because I want to listen. I want to hear what they have to say. But have they ever been able to answer to you what they think is going to happen to increase wages, and then also how we're going to, deal with the AI headwind to ensure that those wages increase?
So when I've talked to these people, what I get as a response, Melody, is, that doesn't matter.
Yeah.
The response to me is wage growth doesn't matter. But I'm like, well, that's the sustainability part of the equation, right? That's how you sustain prices. People have to continue to afford it. And so, no, I've heard absolutely nothing logical from them on how this is going to, maintain. What do you think, Jack?
Travis, housing affordability is not a one-dimensional issue. It ties in money supply, interest rates, tax policy, the job market, right? Housing affordability, we're going to pass a housing affordability law. That doesn't work that way, all right? There's so many variables in that equation. But I just want to tie in that last segment we just did. Now, while you were talking, I did a quick search. According to census data, the U.S. added 1.41 million housing units in all of 2023. That's single-family homes, multifamily condos, apartments, 1.41 million units added. And I just got done talking about, from the household survey, the foreign-born population in the United States grew by 1.5 million, 1.542 to be exact. So from a standpoint of supply and demand, housing demand rose faster than supply. Price is going higher. And remember, that's those same people that are coming into the country, adding to housing demand, are also adding labor supply. So from a job standpoint, from a wage standpoint, the supply of jobs is going up faster than the demand for jobs. And so wages are going down relative to the cost of living. So if we're talking about housing affordability for Gen Zers, which is their biggest issue, according to the data you showed, which was excellent, by the way, that's some potent politics right there. If we're serious about housing affordability for young Americans, then we need to have a serious conversation about immigration policy. We need to stop screaming past each other, and we need to have a policy that balances compassion for immigrants with compassion for younger Americans who are really suffering in this housing market. And one of the many causes of this housing unaffordability issue is that we keep importing demand for housing that is also flooding the market with supply of labor, which hurts housing affordability at both ends. It drives home prices higher and wages lower.
You know, I mean, we're kind of being pushed in a corner to talk about this whole immigration thing. I absolutely hate talking about immigration now. I will say that I don't believe right now the impacts of immigration are affecting home values significantly, maybe a bit, but not significantly. And the reason I think that, Jack, is there's no way for them to get financing from traditional lenders.
Right,
In
but
order
they
to get-
are renting places, right? There's
Yes,
entire
and in
hotels
that-
being rented out in cities, and they're
Yes.
renting apartments. It's that
Right.
works
It has an
its way up
effect.
the housing chain.
It has an effect, but what I'm trying to do is differentiate the eligibility to get financing citizen versus non-citizen. There are barriers, is my point. But nevertheless, yeah, if they're renting houses because they have to, then and then getting jobs, that's going to affect the citizens. I understand that, but my point is thank God there's no financing loopholes. Not yet. And so, yeah, could it get even worse? It could potentially get even worse. But I think the more important issue is for the Gen Zers, Jack. I think that they need to stop looking at all this crap, and they need to start looking at themselves. They need to really buckle down. I mean, and if you think about it, what we just went over, it's right now, even though there is the hope, that second turn of the century hope, right now, it's extremely difficult the younger you are. And therefore, it is more important to have old-fashioned fundamentals. You got to save your money. You got to be careful how you spend. You got to constantly rebudget. I rebudgeted last night. I don't even want to tell you how much money I saved. It was shocking. The problem is like if people are doing their own thing, Jack. They don't have the same priorities, for example, as I did or my grandparents did. Their priorities is get married, have children, get a house, pay all my bills on time, don't go bankrupt, right? Right now, what are people's priority? To get the next best shoes, to be number one on the next video game? I mean, what motivates young people these days? I don't even know.
Trav, could you throw that chart up with the 5-year increments again?
Yeah.
Because I just want to address the trend of doom spending. All right. If you're one of the people who has given up because of this current 5-year chart that shows home prices exploding faster than wages, go back and look at 2000 to 2004. All right. If people had doom spent in 2004 because homes were becoming so unaffordable, and a lot of people did, those people had no nest egg, had no cash available to take advantage in the following 5 years when wages rose faster than home prices. They were left out and they never recovered from that. So, you young guys right now who are giving up, and I understand the rationale. I don't understand the result because I just quit and ain't in my blood. But, I understand why you're doing it and why it feels hopeless. Math doesn't change just because of certain policies. Sooner or later, that same thing is going to happen, like 2004 to 05, how home prices swapped and started going up slower than wages. If you give up now, you will not be able to take advantage when that transition happens. So, while your peers are giving up, if you don't, you will be light years ahead of them when this transition eventually happens.
Yeah, and I totally agree. I want to address quickly just so right now we know a lot of the immigrants are living in hotels, temporary housing, a lot of which I think those hotels, the reason that they are housing immigrants is because they don't have occupancy. Otherwise, it's more, financially beneficial for them to do this. And so I think a lot of those will transition to housing. And one thing I just want to say about just doing a simple comparison to, units added Number one, Travis and I both feel very strongly those numbers are not accurate. We've seen more units added. Secondly, we want to think about, on average in the United States, a household is 2.6 folks. And, so just think of it that way as well. You want to, divide that by 3. So again, the math matters, and it also matters, like, what are they calling a housing unit, and can that change in the future as well? I just want everyone to understand that I still believe we're in an oversupply situation, even with all of these immigrants here already.
I would definitely agree, especially with new homes and from what we've seen personally, boots on the ground. I have a comment here from KOV, a longtime listener on my other channel. Appreciate your engagement. What his concern is a housing correction may not happen because losses would be impossible to handle because debt is too large. I mean, that's why there's bankruptcy and credit tightening and bank failure, right? I mean, it's not too...
It's a little like saying I can't get cancer because it would kill me. Just because the consequences are severe doesn't mean it can't happen, right?
But yeah, but I mean, nevertheless, it's a genuine question and concern he has. Melody, can you kind of hit on this a little bit here? Is the debt too big to fail?
No, I mean, again, we're talking about dynamics here, and our demographics are declining. Our incomes are not rising fast enough. Prices have accelerated. This is just about the inability. This is a demand issue where, people don't have the money to demand or acquire that housing. And so, this doesn't have as much, yes, the debt spending, all of this, and the government's going to try to intervene, but these fundamentals don't change. Like this is the story. And as Jack said, and as we all three say, math matters. And these trends will reverse these fundamentals, no matter how much. And I think it was Lacey Hunt that, he's a great economist, that talked about the productivity of debt, and how, you take an actual productive dollar and you compare that to a dollar spent, in debt, and how unproductive those debt dollars are, and how that is over time, the ability to continue to generate GDP actually lessens. And so, I honestly believe the more debt we take on, the less we're contributing to the economy, and it actually will accelerate some of these trends.
Okay, very good. I got some more stuff here from Jungle Book. Jungle Book, also big member of Discord community. What he's saying is, I think it would also be naive to look at only wage increases. Jungle, we also looked at home increases. So we looked at both wage increases and home increases to compare it. So you're missing part of that in 2008 and 2011. And again, it was only a decade. So it was, it wasn't a 2011, those categories. But anyways, people took pay cuts, but we also had massive price decline. I think wage and price decline could also occur. But let me follow it up by this right here. He has another question. I think this better summarizes what he's asking. Good guy, Jungle Book, again, I love you, man. I hope that dog is trained. One thing that drives me crazy is people that don't train their dogs, especially German Shepherds. I love those dogs. I think it's a German Shepherd. Is it possible we see the opposite of wages catching up, and we see a massive wage and market crash where they both equalize? What do you think, Jack?
I do. I'm just going to go from my own lived experience in 2008, 2009. My base salary didn't change. Actually, my base salary went up a token amount in 2008 to 2009, right? That cost of living adjustment. But the stock in the company I worked with at the time had crashed almost 40%. And so my AIP, my bonus at the end of that year, got cut in half. And well, my bonus was a significant portion of my take-home pay. So my wages did decline, plus most of the stock holdings I had at the time dropped in value. So I didn't have the capital gains that I had the year behind. So my total household income from 08 to 09 dropped substantially. Now it very quickly reversed from 9, 10, 11 from there on out. But absolutely, when you get a deflationary market crash, like we're talking about, if housing crashes and takes the stock market with it, you're going to have higher unemployment and you're going to have lower take-home pay. Absolutely. The question is the relative change. Is housing is going to drop faster than wages are going to drop. I think that's almost guaranteed. And then there's also the fact that what does the central banker do What does the Treasury Department do? Do they try to fight it with stimmies and make inflation worse? That's really hard to try to anticipate, especially when they're throwing around trillions of dollars. But, you know, I can absolutely envision a scenario like Jungle Book is saying here, but it's the relative move when it comes to home affordability, the subject of this segment. I think it's the relative move of wages and housing that's important there.
And I got one more for you, Melody. We only have about 30 seconds. I just want to give a shout out to Orlando. What's up, man? And also, KV, I didn't take it. Hey, no, I hope no one took it as a nasty comment. This is a buddy.
Yeah.
All right, we're part of community. KV, of course not, man. I mean, these types of questions sharpen us also. Keep asking questions, but I appreciate you, man. You're a sweet guy. But no, we didn't take it that way. And I hope no one else did. But I got something for you, Melody. Which one do I want to do? Question. Here we go. Let's do this. Okay, this one's crazy. Here we go. I don't know. I mean, this is a little bit crazy, Melody. I think this is right up your alley. I don't know. Jack, even though I'm just don't look at that. Melody, the U.S. needs the undocumented immigrants to do the cheap labor that U.S. citizens won't take. That's the same in every other country around the world. I'm just bringing this up real quick, even though it's not part of the segment, because I know you would probably be able to answer that question pretty accurately.
Well, I feel like Jack really did a good job talking about this in the last segment that, you know, yes, the elite want this cheap labor to come in, but it is not helping you and me or the forgotten American. They want to pay their maids, you know, under fair market value. We've seen articles like in Miami where the housekeepers are charging $150,000 a year and people are competing for housekeeping services because, you know, there's just not the cheap labor around. And what the elites need is the cheap labor. And so I don't believe it's that we need to import it to do the jobs we don't want. As Jack said, because I'm just like Jack, I've been working. I started actually getting a real paycheck when I was 12 years old, washing dishes. And so I've done a ton of really menial labor in my life, and I did it for the right price. I'm not going to do it if I can't sustain an existence with it. That's a different story altogether. And so I think we've all been a little fooled. And sorry, you said 30 seconds, Travis, but I'm going longer. If you guys remember that that documentary funded by the Obamas called American Factory, which was trying to teach us that Americans are super lazy and the Chinese are super industrious. And it did a lot of juxtaposing of, you know, the Chinese workers, the 5 or 6 to a 2-bedroom apartment, you know, cooking food in the home. And the US worker was living in somebody's basement of like a sister eating McDonald's anyway, watch the documentary. There's a lot of propaganda in that. And I believe that, you know, there's been a narrative for some time that Americans are lazy, stupid, and they don't want to work. I think you give them a pathway to productivity, they're going to come out, and a pathway to reach middle class, to reach what the boomers got, to get their white picket fence and their 2 cars and their 2.5 kids. If you give people a pathway to that, they'll come back. But right now, we're all working for those of us that don't hold assets, those of us who aren't these lucky few, we're all working crazy amounts just to be able to sustain a very unfulfilling existence.
Very good. Jack, you want to add anything?
Yes. Michael, I would highly recommend you go visit a website called WTF Happened in 1971 and pay close attention to that first chart on WTF Happened in 1971, productivity versus wages. And based on your comment, I would say the U.S. needs higher wages way more than we need cheap labor. And I think that talking point that we need cheap labor for the jobs Americans won't take, I think that is a mainstream media, mainstream financial press talking point that has been sold to us, and it is bunk. What happens if we don't get that influx of cheap labor? Well, then the price of those jobs that Americans won't take will have to rise until Americans will take them. And then maybe we won't have such a gap between the productivity of the average American worker and the wages of the average American worker, which has exploded since 1971 when we went off the gold standard and continues to grow to this day. I think we need higher wages more than we need cheap labor.
I think that's fair. I appreciate that, Jack. And we're going to end there, guys, because now that is a wrap. So we're going to go to our last story. Our last story is from Melody. Melody is going to end us out with the story on rent fixing. And Melody, could you throw your screen up real quick? It dropped off your share screen. But I'm excited. And you're also muted. I got you now.
I'm unmuted and my screen is shared. Thank you.
Yes, of course. I'm excited about this one.
All right. I'm excited, but I'm also very sad about this one. Just this one makes me crazy to no end. So this is the multifamily price fixing probe. This started in 2022 after a ProPublica article, surrounding this software that RealPage kind of developed, also acquired different companies. But essentially what is being the accusations here are that through this algorithm, prices are being fixed, and this is collusion, essentially. And so RealPage, for me, I just want to quickly share a personal story. So, I was kind of excited about how much information they had, RealPage, when you could go to their website, use RealPage Explorer, look at all these multifamily listings, look at rents, averages. But what I noticed after a year of tracking them, just frustrated that I was seeing other series come out with price declines. I was seeing price declines for multifamily on realtor.com, Zillow, but there were never any price declines when you looked at just RealPage inventory. It was crazy. And so today I want to talk about this probe because there's been a recent development. And so this essentially got started back in 2022, but there has now been an escalation of this DOJ probe. They are doing a criminal investigation into RealPage. Jay Parsons, some of you may remember him on X Twitter. He left the company very recently, right after this probe was announced. He was a big person out there on FinTwit talking about the rental market. So just want to kind of go to the next here. And so this was the first ProPublica article where they talk about, your rents going up. Why? And guys, here's where I often talk about the bezel, and it goes back to what Jack was talking about the nickel story. If you think there's nickel in the vault and then you value everything like there's nickel in the vault, but then what happens when you realize there's no nickel in the vault? And so when it comes to multifamily, you can think about that nickel as demand. And honestly, in the Sunbelt states, everybody thought everybody was moving there, but that is not at all what happened. And so you can see this quote from Jay Parsons, who basically says, "Never before have we seen these numbers when talking about apartment rents going up, almost 14.5%. And that is just huge amounts of increases that hit you in your pocketbooks. And what's largely being, what they're accusing these folks of doing is because the landlords aren't really looking at actual supply and demand anymore. So let me give you an example. Let's say it's the Orlando market, and let's say you've got, vacancy of around 15%. Well, what would people do typically? They would start competing against one another. They'd start lowering rents. But what you have here instead is just a whole bunch of folks acting in accordance and refusing to lower rents. And what happens then? People are out of luck, and they're either going homeless or they're paying the rents. Okay. And so this is a big story. Just want to kind of tie this in with the political things as well. Also, the Lumi on Lumi violence, which I think we'll talk a lot about here over the next few years. And what do I mean by that? If you think about the Illuminati, was a famous book about, the theory that there were just a handful of people that really run the world, a handful of rich people. But here what you have, honestly, in this RealPage investigation, we talked about those institutional landlords in Travis's segment. These are the multifamily. But in reality, this comes from the Republican side. Harlan Crow is one of the originators of RealPages, of this technology. And you guys might remember Harlan Crow for his relationship with one certain justice here, Clarence Thomas. he was the one giving this guy some different extra benefits. So anyway, just kind of focusing for a second, that Biden has come out and said, just actually to Travis's point about the Gen Zers saying that housing affordability is the most important thing to them. They're saying, for millions of renters, we're cracking down on big landlords who break antitrust laws. But in reality, likely this investigation is a little bit of Loomy on Loomy violence, meaning that you have some heavy hitters from both sides of the aisle, kind of backing these, getting involved in a tussle here from the institutional single family landlords versus these multifamily operators. But what I found was really interesting. There's a quote here. So you see there's two attorney generals who have essentially started a suit, Washington, D.C., and the attorney general from Arizona. And what's important about this and why I'm bringing it up is because this feels very much like the AG settlement that the mortgage companies got into. What will happen is these AGs will kind of get together and decide. If you guys remember the mortgage settlement, that was 49 states that the top 5 had to agree to this attorney general settlement. I believe what you're seeing here are the beginnings of a similar type settlement that we'll see in the future. And the AGs will come together to essentially put this software on notice, because the numbers here are absolutely staggering in terms of how many apartments are on this software. I'm trying to think, over 16 million rental units. And why we're talking about this story today is that there was recently a raid in an Atlanta corporate landlord who is a part of this. And this is pretty brutal. If you look at the way that Atlanta has been impacted, the software-based pricing affects over 80% of their rentals. Since 2016, rents in the city have grown 80%. And the higher vacancy rates have not driven prices down. And this is something I found as well. I was looking at Atlanta on RealPage, wondering how I'm seeing all these stories about vacancy, over 10% vacancy for even single family rental, hearing about squatters in Atlanta really being a burr in the side of corporate landlords. But here you have, essentially rents not going down. And that didn't make any sense to me. And so it doesn't make sense to the DOJ either. And this is why they're launching that investigation. Another funny thing, so we use the words collusion, and I'm looking for the quote that I just thought was hilarious, where basically it said, it doesn't matter if it's in the back room or it's an algorithm, we're going to essentially, this is collusion. And so the funny thing that I wanted to note is that as they had these, apparently RealPage had these price advisors. So let's think the mob, let's think about the shakedown that we often see on mob movies, but they would send price advisors out into the field for folks that would not take the suggestions, so the software would make suggestions about how much you should raise rent or what you should do there. And for those that wouldn't take it, they would send out their goons and essentially strong arm people to make those rent increases. So what we've got here is a very mob style situation where you've got these, multifamily operators using this software. This software is telling you how much to raise your rent or how not to lower it, and what to offer. And that, and apparently one of the backers or originators is also been accused of, being in the pocket having one of the justices in their pocket. And so this is a very important story to watch. I also think it's going to be a big part of our regulatory cycle that we'll have after the bust. But this is largely why multifamily rents have not gone down and have stayed sticky, is around what I believe, has being alleged here, collusion.
All right, very good. Jack, you want to, you got some questions for Melody queued up there?
Yeah, Melody, have any of these articles, I know you mentioned Justice Thomas was involved there, but did you come across anything dealing with regulatory capture? Because, I'm sitting here hearing words like cartel and price rigging. All right. that doesn't work in a free market unless you somehow create barriers to entry for any new competition. A cartel that artificially inflates prices creates its own competition because somebody's going to be like, well, I can undercut these prices and make the money for myself, unless that cartel also conspires to keep the competition out. And that's when it becomes very anti-competitive. So did you see anything about regulatory capture, maybe campaign contributions, anything like that in this research?
Yeah, so I think I kind of found the Crow connection right as we were getting on the air. But I think, again, this is a story we're going to follow for some time. So I think maybe even next week, I might do a little follow piece on the campaign contributions, because I do believe there was some mention about how originally, Trump kind of squashed like the DOJ investigation. They really wanted to, when RealPage was acquiring some other companies, there was some antitrust concerns there. And theoretically, this is what I've read. Again, I don't know, but theoretically, the Trump administration squashed that. And when Biden came in, this is why I was talking about that Lumi on Lumi violence. When Biden came in, they resuscitated this investigation. And then it is now, you had all that happen with Harlan Crow and Justice Thomas being kind of accused of taking those kickbacks or those extra, getting some free stuff, free vacation, things like that. And so it seems to me like this might be a little politically motivated, but in the same vein, it's also in our best interest that we understand we get some relief here.
Melody, I have a question for you.
Awesome. Okay.
And I sit back and I think, okay, you basically said there's price fixing going on and people are getting physically abused.
I didn't say abuse.
That was my impression. They were getting bullied. Is that wrong to say?
I'd say bullied. They were being influenced. Yes.
Okay. I took it as like some hitmen were coming and they're like pushing people around, breaking things. Did any of that happen?
I have no idea. Maybe.
Okay,
we don't know. Yeah.
The point is this. Okay, so the FBI raided them. They're worried about price fixing for rents. But my question is what could the government do about it? I mean, it seems like the only thing that could even be done other than locking them up and sending them to jail for taking advantage of innocent people is price fixing and rent control. And so, Melody, do you think that price fixing, do you think that rent control is a solution?
I don't. This goes back to the same conversation we were having earlier about government intervention. Is this a free market? The chicken and the egg. But that's where, guys, these people, they think on 20 different levels, game theory style, where these types of things. I think, Travis, you're pointing to something very interesting, which is, as much as this seems like the DOJ is putting on its Superman cape and coming in here and is going to try to get, relief for the forgotten American, in reality, this might be just another effort. They're going to use this as a way to do more intervention. And as we've seen in New York, rent control can be very lucrative to those who, work with the government to get the subsidies that are, get these types of rent control agreements. This is one of the reasons why a lot of people in New York are not actually even listing apartments right now and creating a fake supply issue, because they know they can't charge the rents that would make it profitable for them. And they're just kind of leaving them off the market. And so I think you're pointing to how, we're poking holes in this narrative of, it looks like Biden's putting on the Superman cape. He's going to come out here, do great works, take these greedy old folks, to task. But in reality, just like the mortgage settlement, no one went to jail. And the same actors are out there doing the same things with CLOs, instead of mortgage-backed securities, even though I think that's still, there's issues there as well. And so I think we just have to be skeptical. And I believe that this investigation, likely, unless we don't demand otherwise, will be like the mortgage settlement. Nothing really changed. The forgotten American was not helped. And, the rich got richer.
And to the viewers, if you guys can give some questions to Melody. I mean, I see this whole thing going back and forth about whether or not small businesses own 401k. I mean, that's what we're talking about in the so I got some information. Apparently, Michael, 24%, but I also don't know any small restaurant that offers 401k. It doesn't matter. That's not our point. Our point is yes, part-time jobs don't offer that. We're actually saying what you're saying. So I don't know why all the small business. I mean, do you want a job, a small business making 401k? I'm not sure, but if you guys have questions, shoot them up there. Let me see.
If I could, while we're asking for questions, on the subject of rent controls, there's ample data throughout history that shows that price controls don't work. Now, rent control is a very emotionally charged subject. Who could possibly be in favor of rents going up for the poor, right? You sound like a monster. All right. And it's very easy to forget that math matters. The laws of economics don't care about feelings. When you create price controls, you are blocking market signals. And price is a signal that the market sends to market participants about the scarcity of something. If we put price controls in place, we don't let the price of those things rise, then market participants are not incentivized to create more supply to bring those prices back down. And you end up with shortages. And ultimately, that makes things even worse for the poor. You end up with a housing shortage. So price controls are not the answer. Not now, not ever.
That's a great answer. And I have this, guys. We have about 10 minutes before we do our roundtable. This is from KOV. Appreciate you again, KOV, and for your service to our country. Thank you, brother. And thank you for your participation. He's saying revolt, and I think this is right up your alley, actually, Melody. Revolt against a fraudulent market and Gen Zers, stop borrowing and begin to live a simple life to get off of the lending and finance grid. One must live below their means. Until then, enjoy chasing the carrot. Can you talk into his point there, Melody?
Absolutely. I mean, I can because I was a useful idiot. I mean, I was one of these morons that went and got a liberal arts degree. I mean, whatever. And then, had to go and also took out student loans and the belief that, what they told me in undergrad is you have to go to a great grad school. You have to pay this ridiculous money if you're ever going to be a doctor, be a professor. And, I believed all this crap. I took out the student loans, and then when I realized that I would never be able to be a professor and be able to pay these student loans back, I went into corporate America where I then believed the narrative of I saw my paycheck going up and up because I was young and thought, I was young and dumb and thought that layoffs would never impact me. But I also was not smart. Like Jack said, I was one of those that was doom spending between 2000, 2005, because I mean, I didn't have anything. I was already in debt. And, I wasn't living the American dream and I doom spent. And so, then I got myself into trouble. And so my whole point is that, and I realized that the reason I was working this horrible job that was sucking my soul out was because of this lie that, that one day I would be able to achieve all these things. But in the meantime, I wasn't making any quality connections with people. I was only at work. And so anything that I could have done to actually make that dream come true was sort of being sucked up by the job that I was in. And so my point is, when you stop participating, you stop using credit cards, you stop borrowing money, you just use the resource and don't use less, then you can get out of this entire rat race that is there to make you a debt slave. And so I think it's very important that we stop believing these lies that we're told about, where we're supposed to go on vacation, where we're supposed to go to school, what our children are supposed to be wearing, all of these things. Guys, they're just saying this so you'll spend more money because our, GDP is 70% is consumption. And so I just think it's so important. I would agree with this. And Jack says it all the time, well, I'm going to get it wrong, Jack. But the message is live simply, and just that is truly what life is about. It's about your family. It's about the connections you make. It's about those quality experiences, not going to Spain on a vacation. You can't afford where you're yelling at your spouse and kids because you're stressed out because you can't afford it. That is not life. That is not the meaning of life.
She embarrassed us, Jack. She embarrassed us. Your turn, Jack. Have fun with that.
Look, this is exactly why I end every video with live small and dream big. Absolutely. It is that simple life that is the key. I know so many people who make high six-figure salaries, and if they were to lose their job tomorrow, they would be wiped out, because it doesn't matter what they earn. They always spend more than that. And guys, income, it's not about, I know people are like, oh, if I get that promotion, I can afford that nicer car that comes with a higher payment at a higher interest rate and more maintenance expense. You'll never get anywhere if you do that. Your wealth is the cumulative difference between what you earn and what you spend over time. All right. And if you're one of these people going into debt to have nicer stuff, your wealth is moving in the wrong direction. You're paying to rent somebody else's wealth so you can live an artificially inflated lifestyle. You're going to pay for it on the back end. So KOV is right on the money here. I believe in embracing that simple lifestyle. I would say the responsible use of debt, which means at these interest rates, taking out almost no new debt whenever possible, paying off, maybe the old debt, if you were lucky enough to refi your house at 2.5%, congratulations, cling to that. It's going to be a long time before you ever see that again. But he's right on the money here. Embrace the simple life, guys. Happiness does not lie in some consumer crap that you're going to pay interest on if you buy it on the credit card.
All right, you guys, that is going to conclude it. And this is a wrap. So if you guys don't mind, we'll go into our roundtable discussion. I have multiple comments now. I think this will be fun. Maybe we could spend 10, 15 minutes responding to the comments. If you guys have to go, just let me know. Let me see, where's a couple good ones here. Let's talk about this real quick, just briefly. Why is it that everyone in the panel preaches exactly what Dave Ramsey says? Well, that's all I'm going to read, because just that first statement alone. Are you listening to us, Chris? Do you know that Dave Ramsey says that home values only went down one time in history on a nation? Only one time in history? We've had 5 cycles, multiple years. And Chris, I just don't think you're listening. I would say that one of the things that I do appreciate about Dave is he's very adamant about people not getting into credit card debt. I think that's very important. I think where he falls short is there's a certain level where you graduate from. Now I understand not to get myself into debt, but what's next? Well, take advantage of rewards and programs, be disciplined, make more money. And that's where I feel he falls short. But I definitely think that he's a giant grifter fraud. Especially because most of his business is surrounding real estate. It's not surrounding helping the poor get out of credit card debt. Just FYI, that doesn't make people money. It's very sad. But that's not.
Trev, can I comment on that a little bit? There are some people that Dave Ramsey's advice is very good for. Dave Ramsey is like, pay off your house early, never use your credit card, only spend on your debit card. All right. I put every expense possible on my credit card every month, but I also religiously pay it off at the end of every month. I have the discipline and the self-control to do that. There's a lot of people out there that don't have any self-control. Those are the people who need to listen to Dave Ramsey, because they won't pay that credit card off at the end of the month. They're going to take out another credit card and go max that one out. So, I don't really think I resemble Dave Ramsey that much. I am, about living a simple lifestyle, but I'm also all about taking advantage of differentials between interest rates and buying high yielding assets with debt that's maybe a lower interest rate. But there are people with no self-control, and for them, some of what Dave Ramsey's selling makes perfect sense.
Agreed. Melody, this one's for you on the bottom here. Can we, Melody? And this is from Michael. I wanted to throw it up because Michael was so engaging in the comment section. I appreciated that, Michael. Thank you, man. Melody, can you talk a little bit about assumable loans, and can you draw the differential between sub 2 and assumable mortgages, please?
Well, sure. So assumable loans are where you can take over the mortgage, the note. Let me say that over and over again. The note. You can assume the note, or that obligation to pay the debt that's written within your contract, and you can do that with FHA and VA loans. Typically, you can. So let's say that you happen upon someone who has a mortgage for something like 2%, 3%. You want to assume that mortgage. You're going to pay them back the equity. You're going to work with a servicer to do that. That's an assumable loan. The problem here firstly is one a procedure. Most servicers are you have to fully underwrite that loan again to that person who wants to assume it. And so most servicers they're not set up that way. So people may have seen that recently the fee for assumable loans got raised because servicers said, guys, we can't do this unless you raise a fee. And by the way, what it was raised to is not going to be enough to really incentivize servicers to do it. The second thing is you have to come up with enough money to pay back the equity to that original borrower. And so that's prohibitive for a lot of people. And so a lot of folks, I think, oh, this is such a big opportunity. You've got fintech coming in to help you find assumable mortgages. You're starting to see that as part of MLS listings. But in reality, this is a small population. It's not going to fix anything. But if you're out there and you can find one of these and you fit all those requirements, that might be an option for you. The difference between this and sub twos is that it's written within that original contract of an assumable mortgage that it is assumable because someone else will be underwritten and assume your debt. With the sub two, they're coming to you and say, just trust me, bro. Just trust me. I'm that was my best Travis. I don't know how it worked, but anyway, yeah. Okay. But trust me that I'm going to pay your mortgage. We're going to write up this nice little deed and maybe we'll even record it. Although a lot of them aren't doing that. Maybe we'll even record it on public record, but we'll just put this little deed in the safe and I'm going to pay your mortgage. And ultimately I'm going to pay off the house. The problem is they can't get a hold of that note until they pay off. I mean, they have to extinguish that note, pay off the debt. And so if they walk away, you will be left there on that note. They will foreclose on you and your credit will be harmed. So two very different, phenomenons in the housing market, one legitimate, one very suspect.
Great answer. I got a good question for you, Jack. I'm really interested to see how you answer this question. This is from Jungle Book, veteran, scholar, friend, dog owner, champion dog owner. What's the solution to this insane housing market? It feels that the possibility of owning a home gets further and further away. So people are losing hope, Jack. What's the solution here?
How about I unmute? The first solution is unmute your mic, Jack. That's step one. All right. You got to look, we have to let it crash. That's the solution. Home prices have grown too far where it sounds like they're not going to let wages rise. I mean, they're importing labor and they're cranking up on interest rates to try to keep wages from rising by rising unemployment. So one solution to the housing market would be to just stop artificially suppressing wages and let them rise. And then homes would become more affordable slowly over time in a responsible way. They won't do that. So the point is to let it crash. Now, I'm an engineer, mechanical engineer is my background. That's what my degree is. And so Isaac Newton, he says for every action, there's an equal and opposite reaction. And if we're going to let housing crash, that means we need to take the pain that comes along with that. And typically deflationary market crashes are accompanied by things like recessions, several quarters of negative economic growth, things like higher unemployment, a lot of pain for a lot of people. And we don't have any discipline as a society, as a culture. We've acted like every time things get even a little hard, if we just go, please, sir, can I have some more to the central bank? Everything's going to be fine. Or government, won't you do something about this? And the government's like, well, since you asked so nicely, of course. And then they make themselves richer and the problem gets worse and the gap grows. We need to take the pain. That is the solution to the housing crisis. And we refuse to take the pain. And right now, the Gen Zers and the millennials are paying the price to that because there is this massive barrier to entry that is penalizing the younger generations because we won't let housing prices correct.
I got one more question here. I'm going to throw this at Melody, kind of switching. Maybe I should have sent this one to, Jack and reversed it. But, I like switching this up. Great answer, Jack. This is pertaining to quantitative tightening and quantitative easing and unemployment. They're basically asking, Melody, that Paul said that they would start cutting interest rates so they will go down on the federal funds rate when unemployment hits 4%. I've also heard that from a couple people. Unemployment has now hit 4%, and the Fed's like, we ain't touching the rates. Would you agree with that? I mean, what is your thought on when they will start cutting rates as it pertains specifically to the unemployment rate?
Yeah, I'm probably going to have an answer nobody likes, but I just don't think it matters. I think the dot plot was 4.1 or 4.2. I can't remember exactly. I think it was a little over 4%, but guys, I doubt we're going to get there. I mean, I think that we're kind of spooling up for some sort of credit event, collateral shortage, dollar shortage. And so when they actually cut rates, it's going to be because we are in dire straits. And by the way, like let's say that doesn't happen until after the election, then okay, what is a 25 basis point, 75? That's not going to matter in my opinion. And so I think honestly, all of the things that are playing out right now, what the Fed is going to do when they have to act, it's going to be, and when they have to act in a way that will be meaningful, it's going to be because we're in serious trouble. Otherwise, I think they play this game unless we start to see things turn around here quickly. They play this game all the way to the election.
Good answer, Melody. That's going to end it for right now from the comments. Do either one of you have anything to say before we go?
I just want to thank everybody for sticking with us again. 3 hours in. If you guys are still watching, you are amazing. Thank you guys for spending your Saturday with us.
All right. Travis, any last words? Otherwise, I'll take us out.
Nope, I'm good.
All right. Yes, as Jack said, thank you guys so much for joining us and coming along on this ride. We are so appreciative. Looking forward to seeing you next week. And don't forget, math matters.